planned for today. Before going into our normal routine, whatever we have taught in the timetable, yesterday I prepared some important notes of RBI 2024. RBI has issued some notifications. Generally, these notifications are very much important for exam purpose. Whatever current year notifications are there, certainly many points from these notifications, it will appear in exam. That's why I thought it is more appropriate to deal about 20 minutes or 25 minutes on these important points. Maybe some points may be repetition because whatever RBI is giving notification, almost our circulars also will follow immediately. Basing on our circulars, we might have dealt in other sessions. But anyway, it will be again just like a recap or recall. Okay. Now, regarding these notifications, let us move further. First of all, regarding priority sector, important one for current year, maybe Mr. Ravi Kumar might have dealt. Anyway, just for time being, I will give you as a recap. From 25, that means this March onwards, regarding priority sector consideration by RBI, how much we have added to priority sector, and it will be counted for our 40% target. For that purpose, Reserve Bank has divided. What is the division? Districts, they have basing on their per capita credit flow. That means per head, how much credit has gone for each individual. Basing on that, they have given districts with low loan availability and districts with high loan availability. These two are both extremes. And in between, whatever it is there, it is normal 10% they will take. Example, I will tell you. This year, we have added, for suppose, 1,000 crores. Only example we will take. Under priority sector, 1,000 crores. Out of 1,000 crores, 100 crores we have given in low availability area where per person priority sector loan is 9,000, less than 9,000. That is called as low loan availability. So there we have given 100 crores. And in high loan availability means more than 42,000 per person, we have given priority sector loan. So this is high loan availability. For counting priority sector, our targets purpose, what Reserve Bank is telling, where you have given disbursed 100 crores in low loan availability area, that will be multiplied with 125%. That means that 100 crores is considered as 112.5 because 25% adding. Since we have lent that amount in low loan availability area where per capita loan is less than or equal to 9,000 rupees. Whereas district with high availability, wherever you are giving more loans or higher loans to people where per person loan is more than 42,000. That means you are giving higher loans. In that area, whatever you have disbursed, say 100 crores we have disbursed this year in that high area. There they will consider only 90% for our target purpose. That means your 100 crore will become 90 crores only for calculation of our target. This is what Reserve Bank has done this year, basing on per capita, per head, how much loan it is gone. So they may ask low loan area, what is the per capita loan? For considering as low loan area, what is the per capita loan? Like that 9,000 rupees, up to 9,000 per head if you are giving, that is low loan area. Or high loan availability area means where you are giving more than 42,000 rupees per head. It is called as high. And similarly, what is the weightage? Low loan area, 125% weightage. And high loan area, only 90% weightage for our disbursements. This is one important point. And next one, timeline for credit decision for loans up to 25 lakhs to units in MSE segment shall not be more than 14 working days. So this a little differs from our credit risk management policy, where we are telling up to 25 lakhs, it is 15 days, up to 5 lakhs, 15 days, 5 to 25 lakhs, 30 days we are telling in our CRM policy. But Reserve Bank is telling 14 working days. Since it is Reserve Bank's notification, we should keep in mind this 14 working days. Whereas ours is 30 days it is giving, including holidays. So if they ask in exam, you should keep in mind that 14 working days is given for MSME segment credit decisions up to 25 lakhs, right? Second one. Next, regarding risk weights, this already our Jagannath sir has discussed it. Anyway, that's why I will not deeply go through this. Consumer credit exposure, consumer credit, it is enhanced to 125%, and credit card, it is enhanced to 150%. That is the risk weight. NBFCs also, it is there, less than 100% risk weight, wherever it is, that is good rated. AAA rated, normally it is 20% risk weight, we apply. But there you have to enhance 25% because government is telling we should discourage finance to NBFCs up to, because it is exposure is becoming more. For time being, Reserve Bank will put restriction for that. This is only risk weight additionally given. Okay. So AAA rated NBFC, if you are financing, there instead of 20% risk weight, you add 25% extra. So 45% it will become. Similarly, AA rated normally 30%. So add 25, it will be 55. Similarly, A rated, it is normally 50% risk weight for A rated corporates, but you add 25% so that it will become 75%. Whereas BBB rated is 100%. So wherever 100% risk weight is rated, don't add. This is what Reserve Bank has given, right? Next, commercial real estate, residential housing, where floor space index is less than 10, commercial floor space index is maximum less than 10%, where we are giving loans for construction of housing complexes, where in that area, commercial places also will be there. That is not more than 10%. In such cases, we classify it as a commercial real estate, residential housing. So some leverages are given in this. What is the leverage here? Risk weight is 75% only. Whereas for CRE, it is 100% risk weight. Right? Next, suppose if that CRE RH loan is becoming NPA, in such case, 100% risk weight you have to apply. This is what Reserve Bank this year it has given. Right. Next, Brickworks ratings. Last 2022, it was discontinued. And again, this year, they have given Brickworks rating. We can accept for our internal ratings purpose for calculation of capital, etc. But here they have given exposure maximum 250 crores only. Up to that, we can accept Brickworks, not more than 250 crores loan. Loans up to 2 crores, 250 crores, we can get rating done from Brickworks. Recently, it has given. And the next one is REIT and InvIT. I will tell. Real estate investment trust, first one. Second one is infrastructure investment trust. These two are nothing but they are just like mutual funds. They collect funds from investors, public, pool that funds and invest in. REIT will invest in real estate ventures. InvIT will invest in infrastructure ventures. Here the guideline is that REIT, it is sponsored by another, their parent company, whose net worth should not be less than 100 crores. That is, and at least 25% of their assets are deployed in REIT. Of course, it is for their parental company. But for exam purpose, the main point here is REIT, at least 80% of their total loans should be deployed for completed projects which are giving rental income. That means they might have constructed, one promoter might have constructed commercial complex, shopping complex. So after completion of that complex, they can lend to that person. Here, how they will lend? They purchase the owner's stake in that. So here, for exam purpose, 80% of their assets, that means whatever loans they have given, that is assets, they should be in completed and income generating profits. This is point for exam. And similarly, infrastructure investment trust also, 80% of their assets, that means their loans are in completed and income generating infrastructure projects only. Only maximum 20% only they can give for uncompleted or ongoing project works like that, incompleted. Up to 20% only they can give. So 80% of their loans are for completed projects which are giving income. Either infrastructure, that means toll they will be receiving, or in case of real estate, commercial real estate, rental income they will be getting. right? This is another point. Now, fraud related. Here also some guidelines given by Reserve Bank of India. It is almost we can say repetition only. What is that? Reporting accounts meeting the CRILC reporting threshold. That means wherever we are reporting CRILC, 5 crores and above, if it is becoming SMA2, immediately we will report. And 50 crores and above, it is again EWS, early warning signals, that we will be reporting. 25 crores and above, if it is becoming a SMA2, then we will go for forensic audit. So forensic audit cutoff is 25 crores. Early warning signal cutoff is 50 crores. SMA2 cutoff is 5 crores. It is for reporting to CRILC. Right? So while reporting to this threshold, once red flagged, it must be reported to Reserve Bank of India within 7 days. Red flag means some problems are there in early warning signals. It may be fraud, may not be fraud. But whenever we are red flagging, that means we are identifying some problems which may subsequently land in fraud. In such cases, within 7 days, we should report to Reserve Bank of India. This is one guideline. Next, timeline for fraud class, whether it is fraud or not. It is 180 days. In our book also, we have seen 6 months. So within 6 months, they have to take a decision. Is it fraud or not fraud? Here, that is another timeline. Next, entities and persons classified as fraudulent by banks, along with associated entities or their person, they are barred from raising funds or seeking additional credit. Suppose they want additional credit. In such cases, for 5 years, banks are barred from financing. That means we should not finance to a fraud person for 5 years from the date of settlement of their defrauded amount. That means they should have repaid the defrauded amount, or they might have gone for settlement. From settlement date, 5 years, we should not finance to this fraud reported persons. Right? Next, fraud reporting, public sector banks and RRBs below 6 crores to state or UT, police. That means here, state CID, who are looking after economic offenses, for them, we have to report below 6 crores. Earlier, in case of willful defaulters, it is 3 crores cutoff point. But in case of frauds, it is below 6 crores. You report to state CID, economic offenses wing. And 6 crores and above, we have to report to CBI. In CBI also, if it is up to 25 crores, where prima facie staff involvement is there, we will report to CBI Anti-Corruption Bureau. Prima facie, if there is no evidence of staff involvement, then we will report to CBI Economic Offences Wing, EOW. That is 6 crores to 25 crores. Beyond 25 crores to 50 crores, it is BSFC, Banking, Securities and Fraud Cell, BSFC, CBI, we have to report. And beyond 50 crores, it is again CBI headquarters at New Delhi. This is how we have to report to fraud. So here Reserve Bank has given only 6 crores and above to CBI, just like that they have mentioned. Again in CBI, it will come in our classes, this classification, right? Next, reporting to RBI regarding fraud cases, when we have to report. It is FMR1 we call, Fraud Monitoring Report, FMR. We have to report within 14 days to Reserve Bank of India. It is common guideline, right? Next, reporting of check related frauds. Earlier 1 to 2, 3 times this question appeared. Check related frauds. Who has to report? To police authorities. Here to police authorities only we will report, because it is less than 6 crores normally. Who will report here? Paying banker. Who has paid the amount? Because nowadays what happened is in all CBS environment, any branch will pay. Though the check may be, parent bank may be somewhere, post banks or branches also will pay, no issue here. That is why wherever the check is paid, wherever check is parted with amount, which branch has parted with amount, that is called paying banker. That bank has to report. Right? And presenting bank, because encashed party may be having account in some other bank. So that is presenting bank. That presenting bank should provide underlying instrument to the paying bank upon request. Because in truncation system, it will be with the presenting bank only. Only image will go to paying bank. That is why if any fraud is happened, paying bank will report to police authorities, whereas presenting bank will provide this instrument to paying bank for reporting, etc. Right? Now, infrastructure debt fund. It is in our CRM policy also, this will come. Infrastructure debt fund. Yeah, any sir, voice is low. Voice is low, sir. Any this connectivity problem, if it is there, please check. Yeah. Friends, infrastructure debt fund, we call IDFC, NBFCs, because this is also non-banking finance company, which has formed SPV. One NBFC has formed SPV, means a special purpose vehicle. It is nothing but just like subsidiary. That is called as infrastructure debt fund. That is formed exclusively to fund infrastructure companies only. That is called as IDFC, IDF NBFC. So it raises resources from public by issuing rupee or dollar denominated bonds with minimum maturity of 5 years. That means where from the resources will come from for this IDF NBFC means it will collect from public either in Indian currency or in foreign currency, dollar denominated. They issue 5 years bonds and collect money from public. And this amount they will lend to IDFC, that infrastructure companies. So here they should have minimum net owned funds of 300 crores and their capital adequacy ratio, CRAR, capital to risk weighted asset ratio should be 15%. These 2 points are for exam purpose. IDF NBFC, what is their minimum net owned capital means 300 crores and their CRAR is 15%. Next, bad bank we call earlier. Now it is National Asset Reconstruction Company Limited, NARCL. National Asset Reconstruction Company Limited, earlier bad bank. So this is formed by all banks only for purchasing NPS, so that we will get rid of our NPA and we concentrate on our business. This is the purpose of this. For this, initial capital 6,000 crores is contributed, but whom has contributed? For our public sector banks, they contributed 51%. So public sector banks' share is 51% in bad bank, that is National Asset Reconstruction Company Limited. And the remaining 49% it is there. It is by private sector bank and NBFCs. Right? So what is this duty of this NARCL? It will buy bad loans from us, NPS from us. So the NPS will be acquired from banks by paying 15% upfront. Cash means upfront. It is even for any ARC, any asset reconstruction company, if we are selling NPA to asset reconstruction company, in such a case, the ARC should pay us 15% upfront. In the beginning itself, they have to pay 15%. Remaining 85%, they can raise bonds and collect and pay afterwards. Here 15% is upfront condition. For this also same condition will apply. So 15% it has to pay upfront, that is in cash. And remaining 85%, whatever it is there, it is government guaranteed SRs. SRs means security receipts. Security receipts or securitized receipts. Both are called securitized receipts. I will tell you how this for understanding purpose. Say we are having 100 crores NPA with us, 100 crores. And its assets also covered up to 100 crores, it is available. In such case, we will sell it to some other, this ARC. We have sold this ARC. So out of 100 crores, what they will do? They pay 15 crores immediately. And remaining 85 crores, what they do? They issue SRs, securitized receipts, 1 crore each. Like that, they prepare 85 certificates. SR means nothing but certificate, just like your fixed deposit bond. They issue public. Earlier, individuals were not supposed to invest in this because they are barred. But now individuals also permitted. So you also, if you are having 1 crore, yes, you can purchase one bond, one security receipts. Like that, it will issue security receipts and collect funds from public and pay to our bank for our 100 crores. Then it is over. This is how securitization happens in case of NPAs if you are selling to ARCs, asset reconstruction companies. Same bad bank also, same procedure, right? Under the proposed mechanism, NARCL is required to go for Swiss challenge method. Swiss challenge method. What is the switch challenge method? I will tell you, because subsequently in our policy also, the switch challenge method will come. Say earlier our loan, 100 crores is our NPA. See, 100 crores is security you are having, 100 crores. First, we will offer this one ARC, because now 2-3 ARCs are there. One ARC will come and give you quotation, sir, I will buy it for 80 crores. This is called as base bid. Because already one person who is ready to purchase, he has given his quotation for 80 crores. That is base bid. And now our bank will tell, already base bid is there. In this 5% we will add. So 80 plus 5% means 84 crores. If anybody is ready to buy for 84 crores, they can submit bid, quotation they can submit. And some other person gives, no, I will give for 85 crores. Like that, it may go on increasing also. So whoever quotes higher amount, it will be given to them. Whatever the spread is there in that spread, it is called as markup, 5%. So beyond base bid, whoever gives quotation, for them it will give. Suppose no quotations are given other people, then we will give it to this 80 crores wala only who has given base bid. This is called Swiss challenge method. How we will sell assets in Swiss challenge method, right? Right. Next, willful defaulters. Willful defaulters in NPA, it will be dealt in detail. Just only for whatever RBI has mentioned here, that only I will tell. Willful defaulters, in our policy, it is there 4 types of definitions they have given: diversion of funds, siphoning of funds, and selling assets without consent. Like that, 4 points are there. If any point is meeting, means then we will declare them as a willful defaulter. For declaring them as a willful defaulter, now Reserve Bank has given cutoff point is 25 lakhs. That means below 25 lakhs, we cannot declare as willful defaulter as per RBI definition. RBI also, it has taken from vigilance section, in a central vigilance people, they have given this figure 25 lakhs. RBI has accepted. So wherever liability is 25 lakhs and above, if party meets that 4 examples like siphoning of funds, diversion of funds, and selling assets without our consent, amount he has taken away from us. So if he meets that definition, immediately that will be referred to a committee. At head of his committee will be there. They will take a decision first. And that committee, if it is taking decision, then it will be referred to review committee, next higher level. That committee will call that person, and whatever the person submits, if they are satisfied, okay. Other, if they are not satisfied, yes, it will be declared as a willful defaulter. This is what a procedure in our bank also. 2 committees will be there. So first committee is identification committee. Second one is grievance redressal committee or your review committee, whatever it is. So what Reserve Bank is telling in this process is, here we have to serve that person 21 days notice, show cause notice. Why we should not declare you as a willful defaulter? Like that, we have to issue show cause notice. Who will issue the show cause notice? Identification committee. This identification committee is headed by RLFE wing chief general manager of RLFE wing, and other members will be there. They will issue first 21 days show cause notice, and that party is given 15 days time to submit his written representation. First, our show cause notice is for 21 days. To submit representation, 15 days time is given for them. Subsequently, review committee also will call for personal meeting if any, right? But if not availed, decision is made, then we will declare them as willful defaulter. This is what time period given by Reserve Bank of India, because RBI will concentrate more on customer facilities, customer service oriented one. So here 2 facilities are offered to the customer while declaring non-willful defaulters. Next, review committee issues a reasoned order which is communicated to the willful defaulter. Yes, they will declare. Once the person is declared as a willful defaulter, 2 types of punishments are given. First one is, there is no question of additional facilities for 1 year after removal from this list of willful defaulters. LW is lift up. When we will remove from this list of willful defaulters, when party is meeting again our requirements, then we will relieve. We will remove. After removal, up to 1 year, no additional credit facilities. And if they are starting any new venture, 5 years, we will not sanction loan for any new ventures. either for them or their associates also. So here also, just like fraud people, here also 5 years they are barred from availing finance. We should not sanction. So this is given by Reserve Bank of India. Next one is interest equalization scheme for pre-shipment and post-shipment. Current year very important because so many changes and every quarter Reserve Bank is giving guidelines for this. Several guidelines are there. So very important for current exam. Interest equalization scheme for pre and what is this pre and post shipment rate? Reserve Bank is giving interest subvention 2% or 3% to exporters. It is incentive for exports. So here who are all eligible? With effect from July 1, 2024, only MSME manufacturer exporters, they are eligible. Other than MSME exporters, they are not eligible. Other than, that means merchant exporters. Who is this merchant exporter? Merchant exporter will purchase commodity from this SME and they will export. So they are barred from availing now interest subvention. Only SME exporters, they are eligible. That is one important point. So earlier guideline was that 2% for some manufacturers and merchant exporters for 410 identified product. HES antar dini. The another name is also there for this 410 HES sectors, some identified sectors. So for that earlier it was 2% and 3% for MSME manufacturers. That means now this 2% concept not there. Only for SME it is there. That means only 3% is interest subvention is available for MSME exporters, manufacturers. And next one is with effect from 23-24, last financial year onwards, and another restriction it has given. What it has given? Wherever banks are charging repo rate plus 4% interest for exporters. That means if you are charging repo rate plus 4% or more, such banks it is not encouraging. That means they may be restricting interest equalization to such banks, not such parties. Suppose you are charging, your repo rate is, current repo rate may be 6% and your plus 4% will charge 10%. So if you are charging 11% to a exporter, that exporter is not eligible. Like that, they are giving some restrictions. It is not the mistake of exporter again. So there are some restrictions they are giving. This is what prescribed interest rate is repo rate plus 4% only. Beyond that, we should not charge. That is indirectly implied for this. So second point is this one. Maximum rate of interest prescribed for interest subvention is repo rate plus 4%. Next, annual net subvention amount has been already capped at 10 crores per import-exporter code. What is this import-exporter code? Whoever importing or exporting commodities, goods, etc., they have to obtain a code, IEC code from DGFT, Director General of Foreign Trade. DGFT. From DGFT, they have to apply and take one code number that is called IEC code. Each borrower, party, or entity, whatever you call, they will take this. So under each IEC, maximum subvention amount is 10 crores only per annum. It should not exceed 10 crores. So that is ceiling limit. This is also very important for current exam. So here, mainly 3 points. One is only MSME exports are eligible, 3% interest subvention. Second one is maximum rate, repo rate plus 4%. Beyond that, they should not charge for interest subvention. Third one is per IEC code, per party, maximum subvention is 10 crores only per annum, calendar year. So this year they are giving, each quarter they are giving. Suppose in exam, if they ask for up to September, what is the maximum subvention permitted for exporter in case of pre and post shipment export credit subvention scheme? Here for 1 quarter it is 2.5 crores. For 2 quarters it is 5 crores. For 3 quarters it is 7.5 crores. For the entire year it is 10 crores. So in exam, if they ask up to September, it is half of year. That means 5 crores. Like that you have to answer, right? Now, another subvention, KCCS. Everybody knows that it is regarding crop loans. Up to 3 lakh rupees, if you are giving KCC, it is eligible for 1.5% interest subvention, number one. And within 3 lakhs again, for allied activities, ceiling is there, maximum 2 lakh rupees. It is within 3 lakhs only, not 3 plus 2. Okay, this is first point, 1.5%. Next one, additional interest subvention. It is incentive for prompt payment, 3% additional. It will be given for up to 1 year or your repayment, whichever is earlier. If your repayment is early, up to that time, or if your repayment is more, okay, whatever it is, up to 1 year, if they repay promptly, they will get 3% additional interest subvention. This is for prompt payment encouragement, incentive, these two. Next one. So because now two types of interest subventions are normal subvention 1.5 and incentive subvention for 3%. Maximum 4.5 has come, and we have to charge only 4% per annum to the farmer up to 3 lakh rupees loan. Right? Now, the benefit of subvention, it is available for post-harvest loans also. What is this post-harvest loan? Suppose party has already cropped everything, it has come. Instead of selling immediately, party may keep in godowns, that is warehouse. In such cases, interest subvention he is eligible if he is a small and marginal farmer. This point you have to keep in. Post-harvest eligibility only for small and marginal farmers only, up to a period of 6 months. That means 1.5% on main loan and 3% additional subvention for up to within 6 months if they pay. So they will get. This is post-harvest loan. Only condition is in warehouse they have to keep, it is accredited with Warehousing Development Regulatory Authority. Right? That means it is regulated warehouse only, not private warehouses. Right? Next, to provide relief to farmers who are affected by natural calamities. In case of natural calamities, we are restructuring. Up to 33 to 50% height of 1 year, we will restructure. Beyond 50% crop loss, if it is there, means it will be more than 1 year. So in such cases, in case of natural calamities, up to 1 year, suppose if you are restructuring or refacing your KCC, crop loan, in such case, up to another 1 year, both subventions will come. One is 1.5% interest subvention, second one is 3% prompt, both up to 1 year. This is third. And next last point in this KCC is that farmers affected due to severe natural calamities. What happens in case of severe natural calamities? We will restructure it for longer period, maybe 3 years, 5 years, like that. In such cases, the interest subvention, both 1.5 plus 3%, it is eligible. What period? First 3 years, or if you are giving restructuring for more than 3 years, means entire period. Say you have restructured for 5 years. So entire 5 years it will get, maximum of 5 years. Suppose if you are restructuring for 7 years, then interest subvention only for 5 years it will come. So in case of severe natural calamities, interest subvention will come normally 3 years and maximum 5 years, both 1.5% and 3%. Right? So these are subvention points. Next, some customer related, some only single points we will see. UPI payments, tax payments through UPI, it is enhanced to 5 lakh per transaction. Only single point here. Tax payments through UPI enhanced to 5 lakh per transaction. Next, upper limit of offline payment transaction using a payment instrument. Offline, earlier 200 rupees was there, now ceiling is 500 rupees. And within overall ceiling of 2000 rupees per instrument. So now from 200, it is enhanced to 500 rupees per transaction limit. In our circular also it has come. Next, check truncation. Regarding check truncation, it is only general point is given by Reserve Bank of India. Now T plus 1 days we are settling, or it may be taking T plus 2 days also. Instead of that, what Reserve Bank is suggesting is continuously you scan and submit, upload. Settlement should be continuous, not particular timing like that. In such case, what happens is it will be settled within few hours. This is what CTS truncation Reserve Bank has suggested. Continuously scan and continuously present, continuously settle. It will be settled within few hours, right? Next one, cycles. Regarding revision of settlement cycles and business day cutover timings of UPI and IMPS. we are doing our customers are doing transactions through UPI and IMPS. These settlements earlier 8 cycles were there per day. Now that 8 cycles is enhanced to 10 cycles per day. So IMPS and UPI settlements now enhanced to 10 cycles per day. Now timing also earlier 11 PM to 11 PM was there. Now 24 hours to 24 hours. Midnight to 12 hours to next day midnight 12 hours. So these two changes current year for your UPI and IMPS settlements. Right? Next, non-callable domestic term deposits, non-callable deposits, minimum amount they enhanced to 1 crore. Here what they are telling is customers who are depositing up to 1 crore, they can encash any time, premature encash, because non-callable limit itself they have enhanced to 1 crore. Below 1 crore we should not accept. Only that point, bus. Next one, Udgam. It is only sometimes they may ask expansion, abbreviation like that I have given. Udgam means unclaimed deposits gateway to access information. Almost a few banks, they have already started our unclaimed deposits, more than 10 years, whatever unclaimed are there, we have to transfer to this. In Udgam portal, the names will appear. People can verify and whoever are having this unclaimed, they can claim. This is what Udgam portal, right? Next, RBI has decided to increase the frequency of reporting of credit information companies. Normally, customers' data we will be reporting monthly. Now, RBI says frequently, it may be fortnight or even earlier also. This is one point. Next, threshold for bulk fixed deposit raised to 3 crores. Whenever it is raising in 1 to 2, they are asking question. So this year also, they have raised it to 3 crores. Next one, inoperative accounts. I will tell you, instead of reading entire page, I will tell you just in this, what is inoperative account. Normally, if there are no operations in customer account for 2 years, we call it as inoperative. Now, Reserve Bank is clearly telling 2 years from the date of customer induced transaction, not bank induced. Because bank induced means every alternate 2 months, once in 2 months, we will be getting interest. In some cases, once in 3 months, they will be getting to interest to SBI account. They are bank induced. So Reserve Bank is telling, don't take bank induced transactions into consideration. Only customer induced transaction. That means transaction done by the customer or at the instance of customer. If anything is there, then from that date onwards, you count to 2 years. That is one point. Second point is where there are no operations for 1 year, banks have to review, and if there is no operation for 1 year, you send them letter or email or SMS, ask them why they are not operating. Right? If you are satisfied, another 1 year, it will continue. Even if you are not satisfied also, it will continue for 1 year. But RBI says, if you are satisfied, yes, continue for 1 year, another 1 year. Now, 2 years over. If 2 years, there is no customer induced transaction in the account, then immediately you classify it as inoperative. First point. And the second one, first one is annual examination. They told exam, no customer induced transaction, send a letter. After completion of 2 years, transfer to inoperative. And after classifying as inoperative, you should not deduct charges towards non-maintenance of minimum balance. Earlier, we used to do, if there are no balance, every half year, we will cut 20 rupees like that. And whenever it is coming to 0, we will close the account by submitting some NF 799, something like that. But now Reserve Bank says, if you are classifying the account as inoperative, no question of non-maintenance of minimum balance charges. You should not charge charges for non-maintenance of minimum balance. This is important. And next one, suppose party is asking for activation. They may submit your Aadhaar card, photo or PAN card, etc. and ask for activation. Then no charges for activation of the account. You should not collect. So these two are instructions of Reserve Bank of India. Important for exam is no penalty for non-maintenance of minimum balance in case of inoperative accounts. 1 point. Second one is For activation of inoperative accounts, you should not charge any commission. Second point, right? Next, debt fund. It is also related to your unclaimed. Beyond 10 years, if it is unclaimed, we call it as unclaimed deposits, and it will be transferred to DEAF fund, Depositor Education and Awareness Fund. It is as per section 26A of BR Act, Banking Regulation Act, right? Now, banks are required to transfer the credit balance in the accounts to DAF fund. When you have to transfer, last working day of the month subsequent to the month completing 10 months, 10 years. Suppose by last month, October 31st, inoperation has completed 10 years. Then it has become unclaimed. That account you have to transfer by current month end. Previous month, 10 years over, then current month end. By November 30th, you should transfer it to debt fund. This is periodicity. When you have transfer, in which month it has completed 10 years, subsequent month end, you should transfer to debt fund. Right? That is one. And second point, more than 10 years. There is no specific time limit for claiming a refund. Already transferred account to debt fund. Party has come and approached. Sir, I have seen in Udgam portal, my name is there and some amount is there. You please pay me. We will take letter from the party and identification documents and claim from, we will send it to head office. Head office will claim from debt fund. Through circular office, it will go. But procedure now, I don't know, maybe online. So the head office will claim from this debt fund, DF fund. For that, there is no prescribed time schedule for claiming. Anytime, 20 years, 30 years, 40 years, whatever time, if the party comes, yes, you have to pay by claiming through debt fund. And third one, presently the rate of interest paid by RBI on debt fund is 3% simple interest. This is recalled question. How much it is paying? 3% simple interest. RBI is paying on debt fund. Suppose subsequently party is claiming. In such case only, party is not claiming, no interest. If party is claiming, RBI will pay with interest. When it is transferred to debt fund, from that date onwards, it will calculate simple interest, 3% it will pay. Next, key fact statement. From October 1st, it has become effective. That is why it is important. Key fact statement. What is this? Lenders have to provide key fact statement to all new retail and MSME term loan customers sanctioned or on or after October 1, 2024. Either retail or MSME. If you are sanctioning fresh loans from October 1st, you should submit them key fact statement. What is this key fact statement? All your terms, conditions, your pricing, what is the total amount, and what is the amortization schedule. Amortization schedule means nothing but repayment. Your repayment, everything they have to mention. All costs, including your interest, processing charges, or your inspection charges, documentation charges, everything you have to include and call it as annual percentage rate with interest, everything. Why they have mentioned annual percentage rate all inclusive means you should not charge more than this. Whatever you are mentioning in key fact statement, you should not charge more than this. Whatever name you may tell, only out of pocket expenses you are paying to outside agencies. Like CIR, you may pay some amount that, yes, it is payable to outsiders, yes, you take. Or in periodically, now once in 36 months, you are taking EC, encumbrance certificate. For that, we are paying charges to advocates and government charges. Yes, there also you can collect. But without mentioning in annual percentage rate, you should not collect your charges, whatever it is. This is called as key fact statement. And here they have given validity also. Of course, it will come on your normal course validity. It is 1 day valid if loan is repayable in less than 7 days. It is 3 days valid if loan is repayable in more than 7 days. That is validity of this key fact statement also. It is mentioned, right? And credit cards are exempted from this key fact statement. This is also current year very, very important, right? Next, regarding credit cards, a little old, last year only it has come. Regarding credit card issuers, why this norm has come means, Reserve Bank has observed that banks are just like that issuing credit cards without request of party. Simply they are selling credit cards and they are sending to address of the depositors basing on their balance, etc., whatever it is there. because banks are having all data with them and they are sending credit cards, unsolicited credit card we call. And party may not be using, and subsequently banks are debiting annual charges, whatever it is charges. So complaints have gone. Now Reserve Bank is telling, wherever credit cards, such cards are there, they say customer, you take customer acceptance, otherwise you cancel. Suppose party doesn't want a credit card, he has submitted a letter to banks that you cancel this card. In such cases, you have to close within 7 working days. If any balance is there, liability that you collect within 7 working, if no liability is there, you have to close within 7 working days. Otherwise, you have to pay penalty 500 rupees per calendar day. It is payable to the card holder. So whenever party is submitting letter for closure of this credit card, if no dues are there, you have to close within 7 days. Otherwise, penalty at the rate of 500 rupees per day, you have to pay to the customer. Right? Next, RBI to CICs. This also already our sir, Jagannath sir has dealt. Anyway, just I will go fast regarding this CITs. Alert customers via SMS or email when their credit report is accessed by lenders. If some banker has taken credit report, then immediately send SMS or email to the person. As by RBI's mandate, credit information companies will now have to send SMS or email alerts to their customers whenever their credit information is accessed by any credit institution. That means any bank or other financial institution. Right? Next, customers of CS or CICs will now be entitled to compensation of rupees 100 per calendar day. What is this compensation here? Suppose any mistakes are there in credit report of a customer. Customer may bring it to the knowledge of either CIC, that is a credit information company, or to the bank. If it is a complaint to bank, what bank has to do? Maximum within 24 days, they have to send it to the CIC, and CIC has to clear their whatever the mistake is there, rectify within another next 6 days. So total within 30 days, they have to settle the customer complaint. Customer may lodge in our CPGRS website or site may, or he may contact the credit information company. In any case, within 30 days, his grievance should be settled. Otherwise, you have to pay compensation to the customer at the rate of 100 rupees per calendar day. Right? This is also important for current exam. Right? Next, RBI to REs. RE means regulated entity. Our bank is also RE, we call. Release original documents, file charge satisfaction within 30 days of full settlement of loan account. This also Jagannath sir has covered. So if party is closing loan, within 30 days, you have to release his documents and release the security also, whatever we might have registered with CERSAI or ROC. Either CERSAI or ROC, you have to file satisfaction charge. Within 30 days, it should be over. And if documents are lost with us, then you have to arrange through advocates. Within 60 days, you have to arrange and give him. If you are not giving within 30 days, you have to explain to this customer. If customer satisfies, no issue. If it is fault, your fault, and customer is not satisfied, then you have to compensate to the customer at the rate of 5,000 rupees per day for the delay in delivering the documents beyond 30 days. This is another one. Since it is dealt, I will not go through again. Regarding KYC, morning our Ravi Kumar has told that beneficial ownership, now it is reduced to 10%. Earlier it was 15%. Earlier they asked when it was 15%. Now it is reduced to 10%. So compulsorily they will ask in exam 10%. Beneficial ownership. In partnership, 10%. Next, regarding documents of the transaction of walk-in customers. Normally, documents of KYC you have to preserve for 5 years. And similarly, documents of transactions undertaken by walk-in customers. Without account, somebody might have come and purchased a draft with you, walk-in customer. So such the draft challan, etc. That is customer's transaction. You have to preserve for 5 years. Right? Next, money mules. This also morning our sir has discussed. Money mules means it is a mediator account. Fraudster, what they will do, instead of directly creating fraud money into their account, they select some money mules, dummy accounts, some persons identify, they will open their account. First, it will go to other parties' account. From their layers, one account to other, another account, like that. 3-4 money mules accounts it will transfer. Subsequently, lastly, it will come to the fraudster's account. So here it is called a layering to prevent identification from victim to fraudster. Directly, it will not take transaction. So in between layering, 3-4 times it will go and ultimately it will come. This is money mules, means their fraudsters are recruited for transferring illegal money through accounts. Such people, intermediaries, are called as money mules, right? Next, monthly information to all credit information companies. Yes, we are sending customers information monthly to all credit information companies. And what are the accounts we are sending generally? Suit filed 1 crore and above, non-suit filed accounts doubtful or loss, irrespective of amount. Next, small finance banks. It's only 2 points here. Net worth, their net worth should be 1,000 crores. And capital adequacy ratio should be 15%. This is for small finance banks. Next, an entity desirous of starting business of securitization or asset reconstruction. Securitization means purchasing assets. What assets? Financial assets. Suppose you are selling a loan, other securitization, other company is purchasing, securitization company. It is called securitization. Okay, this in policy I will discuss again. And asset reconstruction. Earlier we have seen bad bank. Asset reconstruction, that is RCL, it is a company. So such, if they want to start business, RCL or the securitization company, they should have net owned funds of 300 crores and their capital ratio also 15%. If they have 300 crores, then only they can start this securitization or asset reconstruction company, RCL. Next, banks, there earlier 3 types of our investment portfolio. We use it to classify it as 3 types, our investments. What are? One is held to maturity, HTM category. We see morning in priority, it might have come, held to maturity, HTM category. Second one is available for sale. And third one is earlier held for trading, we used to call. But now third one is your fair value through profit and loss. This is third one. And your held for trading is under this. It is included in this. So third investment name is fair value through profit and loss. Right? Now 3 types of only investments. It's only nomenclature. Now another one, Reserve Bank has given guidelines regulated all banks, NBFCs. Whenever you are seizing assets under SARFAESI Act, all those assets and borrowers' names you have to publish in your website. Normally at the time of auction we will be publishing. Apart from that, what Reserve Bank is telling, so and so person's assets we have seized under SARFAESI Act, like that you have to publish in website. This is what Reserve Bank instruction, latest one. For that, now they says from now onwards within 6 months you have to complete this job. Okay. Next, free look period. For insurance it is applicable. Earlier 15 days was there, free look. If you are not satisfied with insurance policy, you can return that policy within 15 days. You will get back your amount. That is called free look period. Now that 15 days is enhanced to 30 days by IRDAI, Insurance Regulatory Development Authority. It has enhanced from 15 days to 30 days. It is free look period enhancement. Right? Next, commercial paper and non-convertible debentures. Tenor of short-term NCDs and commercial papers. What is this commercial paper? Commercial paper is nothing but good corporates. Here A3 rating, it is there already. A3 rated up to A3, A1, A2, A plus, whatever. Good rated corporates for their short-term loans, that is working capital loans, etc. Instead of going to banks and raising funds, they may issue commercial paper. This commercial paper will be subscribed by others. Even banks also can subscribe. This is called commercial paper. So that means nothing but they are raising funds by issuing commercial paper, just like your promissory note. For issuing commercial paper, we are also acting. Some customers, our customers, they may ask us, sir, I am issuing commercial paper. So you do all work. I will pay some charges. In our head office, separate section is there for this. They do all work. These commercial papers, they will give it to public and collect money and give it to this person. Intermediaries, we are also acting. It is commission we will get. And the non-convertible debentures, which is nothing but bonds or your share certificate like that, but it is not a share. Just like bonds, it will give fixed rate of return. Non-convertible, that is why debentures. So what is the tenure? CP, it is whole term only, minimum 7 days and maximum 1 year. Here also same now. And the minimum investment 5 lakhs, multiples of 5 lakhs. It is whole term, now also same. Commercial paper. But NCDs, non-convertible debentures, minimum 90 days. Non-convertible, maximum 1 year. Here. Remaining all common. Only minimum period is changed. For CP, it is 7 days. And for NCD, it is 90 days. Bus. And minimum rating they should have A3. CP, it has recalled question. So NCD you may concentrate. Next, additional current account for trade settlement in Indian rupees. Last year or before last year, Reserve Bank has given instructions that we are starting all trade settlements, exports, imports, everything in Indian rupees only, not in US dollars or other currencies. It is there simultaneously, but we will give preference to settlement in Indian currencies so that our currency will become strong. This is what our RBI has taken decision. So for this, now what happened? Vastro accounts, that means foreign banks, they are opening accounts with us, Vastro account. If we open with them, Nostro. If they open with us, it is Vastro. So earlier Vastro accounts, what happened? It was in foreign currencies. And now in Indian currencies also, they can open another Vastro account. That is one permission it is given. And now this question is not about that account. Earlier we call it as account, special rupee Vastro account. We used to call that special rupee Vastro account. Now Reserve Bank is telling for exporters also, exporters, you open separate account for settlement of exports. Already party may be having current account or OD. Apart from regular current account or OD, exclusively for settlement of exports, you open separate current account. Just like separate Vastro account you have opened to foreign banks, similarly, you open separate current account or OD account to our exporters also. That is exclusively for this settlement of exports. Bus. This is additional account, current account. Okay. Now, another one, any person who is a resident outside India, that means he is not Indian citizen, he is a foreigner. If they want to open account in India for a particular purpose, what is this particular purpose? Derivative contract. They might have entered into a derivative contract in India. For settlement of the derivative contract, they need one account here. That account you can open in India, either in Indian rupees or in foreign currency. It is interest bearing, not current accounts. Interest bearing, just like your SB, we pay interest also on that. But after completion of this contract, the account will be closed. And the maximum they have given once 6 months timing, it can be extended like that. It is given if contract is not over. So this is another one. That means foreign entities, they can open interest bearing SB account, interest bearing accounts in Indian rupees or in foreign currency, particularly for settlement of their derivative contract. And account will be closed after completion of this contract. It cannot continue. This is one part. Next, liquidity coverage ratio, it will come in Basel. We should have high quality liquid assets to take care of our 30 days outgo of funds during stress conditions. That means if some negative news has come, everybody is trying to encash their deposits. At the time, you should have liquid funds to meet 30 days outgo. So what is this high quality liquid assets means? Government bonds which can be encashed immediately like that. So high liquid assets you should have to meet 30 days outgo under stress conditions. It is liquidity coverage ratio. High quality liquid assets divided by your 30 days outflow. Right? Next, cut-off time for uploading of GST IGE, ICE gate and tin. These are nothing but government revenues. We are collecting government revenues and we are sending it to Nagpur cell, government cell, through various whatever procedure it is there. So at the time you have collected, you have to upload the details. That is what here it is called luggage files. It is to be ensured that these luggage files are uploaded in RBI's QPX or eKuber platform on or before 6 p.m., 18 hours evening. So here timing is only important. For uploading government revenue related files, the cutoff time is 6 p.m., 18 hours. This is plus 1 point for exam purpose, right? Okay, some financial literacy week they have given. It is to be observed during February 26th March. There are some 4 points they have given. We need not worry about that. And remuneration of non-executive directors other than chair of the board. Bank has permitted maximum up to 30 lakhs. Earlier it was 20 lakhs, I think. Now it is enhanced to 30 lakh rupees. Right? Next, here last point in this. Reserve Bank has issued the list of domestic systematically important bank. DSIBs we call. What is the DSIB means? Too big to fail. If Reserve Bank considers that if the bank is too big to fail, very big bank, it cannot fail, then they call it as DSIB, domestic systematically important bank, DSIBs. So in our country, Reserve Bank has identified 3 banks, SBI, HDFC Bank and ICICI Bank. There are 3 banks which RBI considered they are DSIBs. For DSIBs again, Reserve Bank, what it has done, they have to maintain additional capital up to 1%. So it is 5 categories, it is divided. DSIBs may tier 1, tier 2, tier 3, tier 4, tier 5 like that. If it is a tier 1, they have to maintain 1% additional capital. If it is a tier 2, they have to maintain 0.8% like that. 0.222 variation it has given. They have to maintain additional capital for DSIBs, domestic systematically. But here only nomenclature. Which are all the DSIBs? They may ask in exam, odd man out. Which is the odd man out? The 3 DSIBs they will give, another bank name they will give. You have to identify it is non-DSIB bank like that. Okay. Next. Reporting of monthly return and daily transactions under LRS, liberalized remittance scheme, that is $250,000 per annum from individuals' accounts. We can remit to abroad. This is LRS for various purposes, education, medical, etc., maintenance, whatever it is. So here what this is the LRS daily return has been assigned R089 and R010. That is name of this returns, LRS return. One is daily return and another one is monthly return. So monthly return is R089, daily return is R010. Earlier we used to port this in XBRL portal. Now it is transferred to CIMS portal, that is Centralized Information Management System portal of Reserve Bank of India. XBRL also RBI's portal. Now CIMS portal we have to port these 2 reports. Thus, next one. RBI had permitted AD category 1 banks and AD category 2 entities to allow submission of Form A2 through online mode. Submission of Form A2, whenever we are remitting amount, we will take Form A2 and remit. Even student loans, education loans, etc., we are remitting. But online also it is permissible RBI. What is the cutoff limit for permission through online? In case of individuals, up to $25,000, they can submit online A2 form. And in case of corporates, up to $1 lakh, they can submit A2 form online. So cutoff limit for submission of online A2 form, $25,000 for individuals and $1 lakh for corporates. These 2 points. Right? So these are all important points for current year exam purpose. Very, very important. That is why yesterday night only I could call out from our last 2024 notifications. It is already circulated to our SAR. It will come in your circulation because I prepared yesterday only. It will come today evening or tomorrow in your common group. You may go through, but you have to keep in mind these points, though some points may seems to be difficult, but very, very important for current year exam. Right? Now, we go for Next topic. Yes, sir. CRM policy, which yesterday we could not cover. CRM policy. So another 10-15 minutes I will deal, and tea break I will give you. At 2:45 I will break for tea so that time will not be wasted. Okay. CRM policy. General guidelines like your policy framework, broad policy guidelines and IRB guidelines, procedural documents. Will not. So policy framework it is approved by board of directors. Morning our Ravi sir was telling what are all the committees for approval of this. Here also almost same committee, risk management committee of the board, that will approve your policy here, and annually it will be reviewed. And the inspection section, inspection means it will check this how it is functioning, like that. Inspection wing also will check, but approval everything by CRMC. Next, definitions of credit risk. First day I have dealt, because on that day I could not show you slides because it is available in our second file now itself. I will go through a little fast for this without wasting time much. Credit risk, you know that counterparty failure. You are giving loan and telling monthly you pay installment. That fellow is not paying installment. It is credit risk because party has failed in his commitments. Counterparty's failure to meet obligations. It is called as credit risk. Right? And it is classified, when account is classified NPA, we call it as default happened. That means account has become NPA. Right? In case of retail loans, this is another definition. Party may have other loans also. Suppose big parties who is enjoying 5 crore rupees OCC and 10 crore rupees term loan. That person may have 2-3 retail loans also. But what is our norm? One account is becoming NPA means all accounts of that party you have to classify as NPA. But this leverage is given only in case of retail loans. Here what it is that if total interest and our principal, what is arrears are overdue, exceeds 50% of total retail exposure to that party. So the retail total loans exposure may be 50 lakhs. If 25 lakhs and above becomes NPA in retail loans, then only you classify other loans also as NPA. Right? Next, expected losses. I told in loan portfolio, we may be incurring losses two types. One is expected loss, second one is unexpected loss. Expected loss. What is the expected loss? It is average anticipated credit loss in normal course of business due to default in exposures. Exposure means other loans, advances. If there is a default, we will be incurring loss. This we can calculate and we will cover by way of pricing and provisioning. How we will cover? Again, I told you, we will do risk rating. If party is risk rated as moderate risk or high risk, we will charge higher rate of interest. If party is very good party, AAA rated company, then we will give lower rate of interest, like only MCLR or RLLR only. And basing on risk, we will be enhancing plus 0.25, 0.5, like that, basing on risk gradation. This is how pricing we will cover. Provisioning again. Provisioning, we may be increasing. Suppose it is a restructured loan. Instead of 0.4%, we will say 5% provisioning. It has become NPA. Starting from 15% onwards, provisioning will go up. This is how we will cover in case of expected losses. And this expected losses, we calculate, equation is that PD, LGD and EAD. PD, probability of default, multiplied by loss given default and multiplied by exposure at default. Probability of default. What is this probability of default? Here definition is given. The borrower will default within 1 year horizon. I will tell you how we will calculate probability of default. This year, some corporate loans, 100 loans are AAA rated. Another 100 loans AA rated. Another 100 loans A rated. And next year, whether this AAA as it is intact or anything has come to AA. And AA wala, whether it has come down next stage, like that, any fall in ratings. So this is called migration of your risk rating, migration. If it is downgrading continuously, what percentage and in which rating? AAA, in AAA, whether more loans are becoming bad, or in BBB, more loans are becoming bad, what is that percentage? This we have to calculate This is basing on migration analysis. For this 5 years historical data, we will take and calculate probability of default through your risk rating exercise, right? Next, loss given default. What is this loss given default? Suppose if this account becomes NPA, how much economic loss, not actual loss, how much economic loss we will incur if this becomes NPA? So for this calculation again, 7 years historical data you have to take loss given default ke liye. And here in probability of default, simply you are doing risk rating of the borrower only. Whereas in loss given default, you are risk rating facility. What is the loan? What are all collaterals available for coverage of this loan? Whether any seniorities means a prior charge you are having over the assets, like that you will take all aspects and then calculate. Here again, basing on 7 years historical data. For retail lending, it's only 5 years. 7 years historical data we take and calculate. These calculations are always based on historical data. During past 5 years, how the movement was there. Basing on this, we predict for next 1 year, right? Next, exposure at default. Exposure at default means, suppose you have given 10 crores loan. At the time of NPA, what will be its liability? Whether it will become NPA at 9 crores liability, 3 crores liability, or 2 crores liability, like that. So this also basing historical data, you have to calculate. This is how we will calculate expected losses, right? Now, what is unexpected loss again? Over and above expected losses, at a confidence, the standard deviation means at a percentage, we say, confidence level from expected losses. Say expected losses 0.003. Then over that, another 0.1% or 0.2%, like that, they calculate. This is unexpected losses. How these unexpected losses are covered? Then your Basel comes, capital. You have to maintain capital 9%, RCCB, etc. That also we will deal if time permits today, right? Now, this is how we calculate your expected losses and unexpected losses. Unexpected losses we can't calculate. Only it is beyond standard deviation, whatever it is there, it's only estimations, right? Next, risk management committee of the board. This is what headed by our MD and CEO and EDs and other people. They oversee total credit risk management department and credit risk management committee. This credit risk management committee, MD, CEO and EDs will be there in this. And monitor implementation of CRM policy, ensure compliance with prudential limits, decide delegation of powers, collateral, pricing of loans, provisioning, etc. These are all decided by your credit risk management committee, and with subsequently it will go to approval risk management committee of the board. This is apex body is risk management committee of the board, but credit risk management committee, it is deciding committee for your pricing of the loans and what are the collaterals required, provisioning, delegation of powers, who has to sanction these loans. These are all decided by credit risk management committee. Morning AMC, KYC, AML also same thing. CRMC, they will decide, right? Next, who is chief group risk officer means group risk officer of our bank means he is CGM or GM of risk management wing, RM wing. Next, investment grade. Investment grade means where we can lend loans up to this limits, up to BBB, and up to BB in case of SME. We call moderate risk. Up to moderate risk only, we will sanction loans, we will give loans. That is called as investment grade, up to that. And high risk normally, we will not sanction, and it will be by CSE and MC only, right? No authority other than CSE of board and above authorities is having or empowered to permit credit facilities to new borrowers rated as high risk. This is what I told you. High risk borrowers normally CSE and MC only will sanction, no lower authorities, right? And this is another recalled question. If the total eligible provisions are over and above the expected loss amount, the excess can be included under Tier 2 capital up to a maximum of 0.6% of credit risk weighted assets. This is as per and with RBI approval. What is this? I will tell you. At present, our credit risk is measured by standardized approach. And in last class itself, I told, in future, we have to migrate to IRB, internal ratings based approach. In this IRB, again, two types are there. One is foundation approach. Second one is advanced approach. That's what I told, advanced measurement approach. Actually, advanced measurement approach means, again, it will confusion will go to your operational risk. Simply, we call this advanced approach of IRB. Not measurement, advanced approach of IRB, internal ratings based. What is this internal ratings based and standard? For understanding, 1 minute, I will tell you. Standard approach means what Reserve Bank is telling, banks are not having expertise at present to calculate what is the risk involved in each account. So till you develop expertise, you do risk rating by external agencies. ECAIs are there. CARE, CRISIL, ICRA, Brickwork, all these are ECAIs, external credit assessment institutions, external rating agencies we call. You do rating from external agencies, and basing on their rating, I will give you figure, risk weight, how much you have to keep. If it is a AAA rated by outside agency, you apply 20% risk weight, multiply with 20%. If it is a AA rated, multiply with 30% risk weight. These risk weights are given by Reserve Bank of India under standardized approach or standardized method. Once you become expert, then you migrate to IRB, internal ratings based. In IRB also, advanced approach you go. After going to IRB, advanced approach, I will inspect, Reserve Bank is telling, I will inspect. If I am satisfied, I will permit you to go for IRB advanced. Once you are permitted means, you need not approach your external rating agencies for risk weight purpose. You calculate your own risk. Now your CIRM is doing that only. Through CIRM, we will calculate risk and apply our risk weight so that we need not depend on outsiders. This is called advanced approaches. Still, we are not migrated because Reserve Bank is telling, once you migrate to advanced approaches, you cannot come back. It is natural justice. After passing degree, you cannot again come to intermediate or 10th class. Not permitted. Similarly, here also, Reserve Bank is telling, once you migrate to advanced approaches, you cannot come back to standardized approach again. So you think and then go. That is why we have not taken decisions so far. Still, we are following standardized approach only. Though we have developed CIRM and it has become very famous. Still, right? Here, this 0.6, what it is, as per standardized method, what Basel is telling is, old method I am telling, as per standardized method, whatever your provisions are there, general provisions and loss reserves we call, whatever your provisions are there, all these provisions up to 1.25% of risk-weighted assets, up to 1.25% of risk-weighted assets, you can include under your Tier 2 capital. Up to this level only permitted. Suppose our risk-weighted assets as on September, 7 lakh crores. Total assets, 10 lakh crores. Multiplied by risk factor, then it has come to 7 lakh crores. Out of 7 lakh crores, what is 1.25, 7,000 plus another 2,000 approximately. So less than 8,750 crores, something like that. Up to that amount, you can include under your Tier 2 capital provisions. And if you are migrating to advanced approaches, you are calculating your own expected loss. And you are having provisions already with you. If expected loss is more and provisions are less, that means it is more loss, there. Then you deduct from your capital, Tier 1 capital, the two equity. Suppose your provisions are more and expected loss is less. That means more than expected loss, you are having more provisions. So whatever that provisions are exceeding expected loss, that you can take under your capital, Tier 2 capital. So provisions exceeding expected loss, you can include under tier 2 capital. Up to what extent here again? 0.6% of your risk-weighted assets, not entire amount. 0.6% of your risk-weighted assets. If it is a standard method, 1.25%. If it is an advanced approach, 0.6% only. This is the difference, right? Now, yeah. What we do is 5 minutes. We will take up to this. Okay, another one slide only. Then we break for tea. Next, risk-adjusted return on capital, RAROC. So again, risk-based pricing we are doing. So basing on that risk-adjusted return on capital, for this capital, how much we are getting return after adjusting your risk. Okay, that will be calculated at head office. But for current year exam purposes, what is the cutoff limit for calculation of RAROC? So here above 7.5 crores, all your loans, that is corporate, MSME, agriculture, all loans, whatever it is, where liability is 7.5, above 7.5 crores, that is exposure above 7.5 crores. This RAROC is to be calculated at head office level, they will calculate. So for exam purpose, what is the cutoff limit for calculation of RAROC is above 7.5 crores, right? Next, exempted from RAROC below 7.5 crores, exempted staff loans and your VSLs, etc. under restructuring, that also exempted. Next, RM wing shall review RAROC proposals above 100 crores, right? Next, for corporate exposures, probability of defaults are required to be estimated for each borrower rating grade, and the LGD and EADs and effective maturity are required to be estimated for each facility. As I told you, PDs you are calculating borrower wise, we are low risk borrower or high risk borrower like that. Whereas LGD, each facility, suppose for term loan, what is the security? For working capital, what is the security? Or for if it is an infrastructure project, whether you are having rights on your toll collections, whether it is first right or second right, seniority, that is what. These are all calculated for LGD approach. Okay. And they are to be required for facility level. So the difference between your probability of default, that is L and LGD, is that PD is customer wise, LGD is facility wise. In PD, there is no question of collateral securities, etc. Whereas in LGD, we consider all collaterals plus seniority, etc. That is the difference. During transition period, 2 years, what Reserve Bank is telling is, as I told you in earlier example only, if you are migrated to advanced approaches, continuously 2 years transition period, you have to maintain both capitals. What is this both capital? Capital required under standardized approach. Now what we are following, standardized approach, and capital required as per IRB, internal ratings based. What happens is, if you migrate to IRB, capital requirement will be lesser than what is in your standardized method generally. That means if you migrate, it will be advantageous for us. Okay. So transition period, if you are migrating from standardized to advanced approach during graduation period, you should maintain both. So first year of migration, you maintain 100% of your standardized approach, capital required, 100% of capital required under standardized, and advanced approach, whatever capital is required. Second year onwards, 90% of your standardized approach you should maintain. Suppose 1 lakh capital today we are having under standardized method. If you calculate under advanced approaches, we may require 80,000 crores only. But Reserve Bank is telling, first year you keep this 100 crores as it is, and that's 1 lakh crores. And the next one is 80,000 crores as per your advanced approach. Second year, 90% of this 1 lakh. That means 90,000 crores next year you keep. Till you completely migrate to 80,000 crores. 80,000 crores is under IRB. So while stepping down, don't jump from top to bottom. You step by step, you go. This is what Reserve Bank is telling, right? The bank shall continue to measure credit risk based on the standardized approach along with IRB until IRB approval from Reserve Bank is there and IRB approach is in place, right? Now, up to this, into this, now what is our Basel related or your how to calculate your probability of default, etc. We have completed. Now we are entering into the main policy and strategies. For this, I will give a little gap for you because afternoon session continuously also it will not go inside. To go inside now 15.56. What we do is 5 minutes we take tea break and then we assemble after 5 minutes, right? Tea break. Up to what? 1556, 356. So 3.56 to 402 plus 6 minutes. We take tea break, sir. 4:02 exactly, we will start, sir. 4:02.
Okay, sir.
Yes, sir. Thank you. Yes. Yes, friends. Now we proceed for policy and strategies. In this first large borrowing framework, of course, this already it is replaced with our large exposure. Simply, for understanding purpose, I will tell you, large borrower means the party is enjoying 10,000 crores and above from banking system. We call them as large borrower. This is to avoid concentration risk. What Reserve Bank is telling, what is concentration risk? If you are giving more loans to a particular party or particular group, then if that group or party fails, our loan and bank also will fail. That is why don't lend all loans to a single group or single borrower like that. We have to spread. This is to avoid concentration risk. So here, large borrower means 10,000 crores and above if limits party is enjoying. We call them as large borrower. And Reserve Bank is telling to such borrowers don't lend liberally. How much you can lend to large borrower? Whatever they are bringing additional funds, that is additional capital. In that only 50% of their additional capital only you give. This is for large borrowing framework. Now it is replaced with our current one, which is large exposure framework. Almost similar only, but here large exposure frameworks. Now we are following large exposure framework. What is this here? Again, this is also to address concentration risk, right? What is large exposure here? Large exposure means exposure to counterparty equal to or 10% of our banks, equal to or more than our 10% of our banks eligible tier 1 capital. Here, banks eligible tier 1 capital as on March, our T1 capital is 1,04,000 crores. Say approximately 1 lakh crores as on T1. So here 10% of 1 lakh means 10,000 crores, almost similar figure just like our earlier one only. So wherever you have given loans 10,000 crores and above to any borrower or borrower group, they are called as large exposure, right? That is definition. And the next one, what are the limits here to such borrowers? How much maximum loan we can give is maximum 20% of our tier 1 capital we can lend to large borrowers. This large exposure means single borrower. To a single borrower, maximum 20% of our tier 1 capital. So our tier 1 capital is 1 lakh crore. 20% means 20,000 crores. To any single borrower, we should not lend more than 20,000 crores. This is what single counterparty. And if it is a exceptional cases, in exceptional cases, bank board, they may enhance additional limits of another 5%. That means if you take again our 1 lakh crores, 5% means another 5,000 crores. So up to maximum 25,000 crores, we can lend to a single borrower, that is corporate, not group. And again, group I am coming, right? Next. Groups of connected counterparties are your group. For group, how much we can give? Maximum 25% of our tier 1 capital. That means 25,000 crores as on our capital. So we cannot lend more than 25,000 crores to a group. For example, Reliance all as a group. So entire Reliance as a group, we should not grant loans more than 25,000 crores all put together. This is what group maximum exposure to a group. So for individual borrower, 20% of our tier 1 capital and 5% additional permission by board. For group borrowers group, maximum 25% of our tier 1 capital we can give. This is what we call as a prudential exposure norms. Prudential exposure norms. Next, what is the definition of connected counterparties? Group we are telling in a connected counterparties means there is a specific relationship or dependency such that if one account is fails, all other accounts of that group also likely to fail because they are interdependent on each other. Right? This is how. Suppose in another Reliance group, what happened? All continuously one by one, almost failures has come. Only in Reliance group, one group only it is successful. Second group is failing. Next, group of connected counterparties, control relationship or economic dependence. These are definitions for group of connected counterparties. Where we call this is a group of connected counterparties means if there is a control relationship, that means in board, management of the board is common or majority of the people managing one firm or same people are managing other firm also. That is control relationship or economic interdependence. Economic interdependence means one firm's end product is second firm's raw material. That means both are connecting. If one firm fails means there is no supply of raw material to the other firm. Like that. If one of the counterparties to fail, all other counterparties were likely to fail. This is and group definition. This several times recalled question. What is the definition of group? It is commonality of management and effective control on the management. It is the basis for determining group associate concern. Definition is commonality of management. As I told you, managing people are both in both groups, they are common. Both firms, they are common. Effective control on the management. Or who are the managing partner or managing partners, main people. They are also main peoples in the other firm. This is effective control on the management. Now, exposure to NBFCs. To each NBFC, how much we can give? Here, 20% single NBFC, just like our single borrower now. If it is again group means 25% of our capital. Same guideline. But in case of gold loan companies, NBFC gold loan companies, where 50% or more of its total financial assets, mean total loans given by that NBFC is gold loans only. In such case, we classify it as a gold loans NBFCs. For them, maximum restricted is 7.5% of our tier 1 capital, maximum. That means if 1 lakh crores is our tier 1 capital, so 7,500 crores maximum we can give for this NBFC gold loan company. Next, large exposure rules for global systematically important GSIBs, global systematically important big banks. And DSIBs, domestically, 3 banks earlier we have seen. For them, what is the exposure? GSIB to another GSIB, global to another global is 15% of eligible capital base. And non-GSIB to a GSIB, non-global GSIB to a global GSIB, it is 20%, just like our single corporate. DSIBs governed by interbank exposures. DSIB are domestically system because local banks only, your state bank, ICICI, or your HDFC, they are local banks. So if you want to give loans to these companies, banks, either state bank or HDFC or ICICI, they are 25% of our capital. That means now as per current norms, it is 25,000 crores we can give. This is a prudential exposure norms. How much maximum loan we can give to companies, either individual company or group of companies, right? Now, these are also very important one. Credit exposure ceiling for individual and non-corporate borrowers. Corporates earlier we have seen individual corporate high to 20%. If it is a group corporate, it is 25%. NBFC is also 20-25. Gold loan company 7.5%. Like that we have seen. Now non-corporates are individuals. So how much it is here? Individual other than schematic loans for non-business purpose. maximum 30 crores we can give. For any individual, if it is not for business purpose, it is maximum 30 crores only we can give. And individual borrower for business purpose or proprietorship, then 75 crores maximum we can give. Individual for business or proprietorship, 75 crores. Similarly, single entity with the constitution as association and HUF. HUF or association, here also maximum 75 crores. Next, single entity with constitution as society and trust. Society and trust, but it is formed for educational institution and hospital. Society and trusts are divided into two types again. One is educational institutions and hospitals. And second one is other than educational institutions and hospitals. If it is educational and hospitals, we have to give priority. That is why, not priority sector, we have to give priority. So that is why here, if it is a low risk, we can sanction up to 350 crores. If it is a normal risk, 250 crores. If it is a moderate risk, 200 crores. If it is a high risk, not for fresh loans, only for renewals, it is 125 crores. It is for society or trust for hospitals and education. And other than hospitals and education means 100 crores maximum we can give. Society or trust formed for other than hospitals and educational institutions. So maximum is 100 crores. Partnership concern, maximum we can give 125 crores. And LLPs we can give 125 crores maximum. Right? So these are all maximum limits. We call them as prudential exposure norm for non-corporates. Earlier corporates, in percentage to our capital, tier 1 capital. Here non-corporates figures it is given this much maximum amount. Right? Next, substantial exposure. What is the substantial exposure again means? Out of your tier 1 capital, more than 10% of tier 1 capital, how many loans you have given? Earlier we have seen 1 lakh is our tier 1 capital. 10% means 10,000 crores. So more than 10,000 crores and above, all loans at head office level, whatever you have given all over India, all bank level total, 10,000 crores and above, how much that quantum is there? Entire quantum. That is called substantial exposure. Here what Reserve Bank is telling, substantial exposure, you can fix it at 600% or 800% of your capital funds. That means out of 1 lakh, 600% means 6 lakh crores or 8 lakh crores. It is up to you. You can fix. So what Reserve Bank is telling under substantial exposure norms, if you take current figures, all loans exceeding 10,000 crores and above, all loans, entire bank as a whole put together, not to exceed 6 lakh crores or 8 lakh crores. That 6 lakh at 8 lakh, board will fix. Right? This is what we call substantial exposure norms. And the definition of unsecured exposure. This is also sometimes exam it is appearing. What is unsecured exposure means? If you are sanctioning a loan where security ab initio means from the beginning is less than 10% of your liability. Suppose 10 lakhs loan is given and you have taken security out of 10 lakhs, less than 1 lakh security is taken. Then it is called as unsecured exposure. Right? Next, various exposure ceilings. Of course, figures it is given for individual. Earlier, we're going to exposure to single borrower 18,500 crores. Earlier, we have taken an example. It is 20,000 crores. It is basing on our September figure. So this basing on March figure, he has taken 18,500 crores. Maximum you can give. And a group, it is 23,000, something like that. These figures we need not worry. Earlier, they used to give in our LDGM surplus, but now bank is giving in the form of surplus only. Right? These are all figures for that. How much you can give maximum. Next, against shares. To individuals only we can lend against shares, not to the firms. Only individuals we can share. And no loans to partnership and companies against primary security of shares. That we have seen in our restrictions for lending in last session. Right? Now for individuals we can give, how much we can give? Maximum 20 lakhs per head only. Per person or per borrower, we can sanction maximum 20 lakhs only against shares. And these shares should be in demat form. Now there is no question of physical shares accepting. Chale gaya wo. Only demat shares only we are accepting. So in demat shares, maximum 20 lakhs only you can give. And if they are subscribing to IPO, then maximum 10 lakhs only we can give loan. Subscription for IPOs. Suppose ESOP, Employee Stock Option Scheme. What is this Employee Stock Option Scheme? Companies sometimes they offer shares to their own employees at concessional rate of interest, concessional rate, lesser rate. We call it as Employee Stock Option Scheme. And for that, up to 90% of purchase price we can give, but maximum 20 lakhs only. 10% only margin. Otherwise, normally margin against shares is 50%. But here 10% only we prescribe, right? And if they are in demat form, 25% margin. Next, OD against property to stock brokers. Normally we sanction loans to share and stock brokers also. There also 50% margin they have to maintain. Out of 50% again, 25% should be there in the form of your cash we call. That is their own equity. Remaining 25% may be in the form of other securities. For stock and share brokers, we sanction loans only for their stock broking purpose, not for hoarding. That means buying shares and keeping with them not permitted. Only for your business purpose, stock business, share business purpose only we will. Against properties, 40% is margin. And section 19, subsection 2 of Banking Regulation Act. Almost several times this question appeared in exam. Section 19, subsection 2 of Banking Regulation Act says is, you are accepting shares of a company in various modes. Maybe you are extending loans up to 20 lakh rupees per head. You may be extending loans, or you may be accepting as a collateral security, or you may be directly investing in shares of that particular company. That is why whatever mode here they have given, you see, as a pledgee, that is for security, as a security, a primary security, or your collateral security, you may be accepting a mortgage, or absolute owner means you are directly investing and purchasing shares of that company. Whatever mode, all put together should not exceed 30% of paid up share capital of that company, or 30% of paid up capital and reserves of our bank, whichever is less. For this again, at head office level, again they have fixed threshold limit, 25% they have kept. Against particular, say Reliance Industries. Again, against Reliance Industries, how much maximum loan you can give? Maximum up to 30% of that Reliance company's capital, or maximum 30% of our capital and reserves. That is the maximum ceiling. So again, it should not exceed. If it exceeds, the Reserve Bank penalize. Reserve Bank penalty will come. So at head office level, what they are doing, monitoring. When it is reaching 25%, they says now we will not lend that much liberally against a particular company because it has reached the threshold level. Right? Next, this is what section 19, 30% and 30% you have to keep in mind. Next, same section 19, subsection 3 of Banking Regulation, what it says is, if any of our director worked earlier in that company, bank should not hold shares, whether as a pledgee or mortgagee or absolute owner in any company, in the management of which any managing director or manager of the bank is in any manner interested. If some of our director is having interest in a company, interest means maybe he is a partner or your major shareholder or something like that. Such cases also, you should not take the company shares. No loans against that company shares. If some of our directors or managers are interested. This is what section 19, subsection 3 of Banking Regulation Act, right? Next, ceiling in respect of exposure to other banks. To other banks also we can give loans. But here for public sector banks, as per large exposure framework, what is our large exposure framework? What they says, if it is a other public sector bank, up to 25% of our capital we can give. Same thing applies here. But in respect of cooperative banks, based on gradation matrix approach of cooperative banks, it is restricted to 25% of regulatory capital tier 1 plus tier 2 of the cooperative banks here. So maximum 25% of the cooperative banks total capital tier 1 and tier 2. Up to that extent we can sanction to cooperative banks, provided CRAR, capital ratio of the said cooperative bank, is not less than 9% for Tier 1 UCBs, urban cooperative banks, and not less than 12% for Tier 2 and Tier 2 to 4 UCBs. So their minimum capital ratio also, Tier 1 means in cities, big cities, their 9% capital they should have. Tier 2 to Tier 4 small areas, their 12% capital they should maintain. Then only up to 25% of their capital, we can sanction loans to cooperative banks. In respect of private sector banks, if their net worth, the tangible net worth is 1,000 crores and above, then we will sanction. Similarly, exposure to Indian joint ventures or wholly owned subsidiaries abroad or overseas step down. What are these companies? Suppose here one big company is there. They started one subsidiary in abroad or joint venture with some other company. They formed joint venture in abroad there. So for such companies, how much we can give? It is subject to limit of 20% of the bank's unimpaired capital funds. Unimpaired means after deduction of losses, etc., all unimpaired capital up to maximum 20% of our capital. Normally, your Tier 1 capital plus Tier 2 capital, total whatever it is there, it is unimpaired only. After deduction of that only, we are showing. So out of this 20% maximum, you can sanction. Normally, if it is not a joint venture, local company means single corporate 20% with board power, another 5 up to 25% we can go. Right? But here up to 20%, same num almost. Whatever you are sanctioning for domestic, for abroad subsidiaries also same 20% of your capital. Next, ceiling for lending to near prime and subprime borrowers on fresh retail. Recently it has come, retail lending. Who is this? Near prime means CRG3 or their score. CAC score is 730 to 681. Then we call near prime. And subprime means CRG4 or CAC score 300 to 680. That means not that much good borrowers we can say. Near prime and subprime means not below normal risk, that is moderate risk or your high risk like that. And maximum ceiling, what is here? 10% of retail loan sanctioned during year. Suppose you are sanctioning 100 crores under retail, for near prime, you should not exceed 10 crores, 10% of your retail exposure. Similarly, for subprime, it should not exceed 5%. That means 5 crores. If you are sanctioning 100 crores, only 5 crores only you can sanction for subprime. That means it is only to control not good rated companies, not good rated individuals, because retail loans. So for them, you can sanction only maximum this much. This is what near prime and subprime individual retail lending borrowers limits. Again, triggering points. What is this triggering point means? When it is reaching 9%, then they will stop all loans and say very carefully now you give. So from that point onwards, very much caution exercise. That is what triggering point. It is 9% if it is under CRG or 8% if it is under CAC. Similarly, for subprime, it is 5% under CRG, 4.5% under CRG. If it is a CAC score, then 4%. This is triggering point. Current year, it is important because it is latest one. Now, operational process and systems, pricing of credit, how we will fix the rate of interest. Exposures above 25 crores, it is grid methodology. Grid methodology, whatever your outside external borrowings, external rating agencies, whatever they are doing, basing on that, we will fix grid methodology. And above 2 crores to 25 crores, CIRM, our internal ratings. As I told you, it is developed along with the CRISIL long back. Now we have developed our own. It is CIRM internal rating model. 2 to 25 crores, basing on our CIRM, we will. Even up to 25 crores, if both ratings are there, your external as well as internal, you have to consider internal only for our decision making purpose, either delegation of or for your ratings purpose, up to 25 crores. Next, exposure above 2 lakhs up to 2 crore to MSME and other sectors. 2 lakhs to 2 crores, MSME, etc. It is our small value model or manual model. Because up to 20 lakhs, it is small value. Beyond 20 lakhs, it is manual model. Basing on that, we fix pricing. And exposure 2 lakhs to 2 crores for agriculture and allied activities. Here scoring norms. Because agriculture and allied we cannot do under small value because there is no balance sheet. So here scoring norms has given. Retail lending products schematic. For each scheme, they will give separate rates. Exposures up to 2 lakhs, rate of interest as advised by bank from time to time. Right? Next, concessions in rate of interest or charges, if permitted. Up to what time it will be available? It will be co-terminus with original tenability of sanction or till first extension. You are sanctioning ODOCC. You have given concessional rate of interest. Up to 12 months, tenability is fixed. Okay. Beyond that, party will ask extension. First extension, 3 months, granted. Up to that, your concessions will apply. Second extension, another 3 months also permissible, but there no these concessions. You have to charge normal rates only. This is up to what extent concessions are permitted. Accounts where concessional rate of interest is permitted, if it slips to NPA, the rate of interest to be charged on such account shall be applicable rate plus 2%. Whenever account is becoming NPA, immediately you have to add 2% rate of interest. Right? Next, on receipt of external or internal ratings based on ABS, pricing to be reviewed. Whether it is going up rating or going down, it is becoming good rated or bad rated. So basing on that, you have to review. If deterioration of rating, there is a fall, till review of pricing is completed, additional rate of interest to be charged. Our Jagannath sir has given very big table as per circular it is there. It varies from 0.5% to 1.5%. Say LR1 to LR2, 0.25%, LR2 to LR3, some 0.5 like that, they have given table. So as per that table, if there is any deterioration in rating, we will charge additional interest varying from 0.5% to 1.5%, depending on downgradation of the rating. If downgradation of rating is 2 or more notches by 2, so LR1 to LR1 to 1, LR3 2 notches, or LR3 to normal and moderate risk 2 notches, like that. If it's fall, there is a fall 2 or more notches, then 25% additional collateral security is to be obtained within 6 months of downgradation of rating. Otherwise, 1% additional interest shall be charged in addition to the above that 0.5% to 1.5% earlier I told you, no. Apart from that, here another 1% you have to charge for downgradation of more than 2 or more notches. In case any externally rated account moves to unrated category, earlier rated externally, but now rating is not there. Already 15 months over and rating is not now eligible. We cannot take after 15 months or after 18 months from the date of signing balance sheet. So in such cases, we have to charge additional interest 1% to be levied over and above the contracted rate from the date of being treated as unrated till review of pricing is completed. Whenever the account becomes unrated, rated 1, it is becoming unrated. Till review is completed, you charge 1% additional rate of interest. Next, concession and applicable rate of interest on account of upgradation of external or internal rating of the borrower. Concession to be given for exposures above 7.5 crores without waiting for regular renewal or reset. Here, especially for pricing purpose, whether to enhance pricing or reduce pricing, they say 7.5 crores and above. If there is upgradation, it has become good rated. But for this, you have to take external rating, not internal one. If both are available. If external is not available, yes, internal CARM we will accept. So if there is upgradation and if limit is above 7.5 crores, such case immediately you give concession. This is last year recalled question. Cut-off limit they asked. Next, Canada Bank proposal rating CBPR. CBPR, it is a credit scoring matrix. Applicable for corporate, this applicability. CBPR is applicable for corporate loans and MSME, agriculture, food processing loans, etc. 10 crores and above. Cut-off point is 10 crores and above applicability of CBPR. Retail lending, restructured accounts and government accounts are exempted from CBPR. And the scoring sheet is meant to be used as a pre-sanction exercise. Here description of ratings is given. CBPR 1, it is low risk, and scores also it is given. With the points only, I will not. Only thing is CBPR 5, it is very high risk or no go. No go rated. This we will study. No go ka. Next, high risk parameters also it is given. CBPR may. What is that? First one is SMA2 for past 3 months. SMA2 for past 3 months. That means almost it is moving to NPA. Next one. Still it is maintaining, means SMA2 may some adjustments that part repayment, something like that, it is happening. Otherwise, SMA2 itself is 61 to 90 days. Right? Next, interest coverage ratio less than 1. Current ratio less than 1 and no fresh infusion of capital. These are also parameters for high risk category. Right? Next, who will confirm this CARM rating approval by executive set, RM being HO. Up to CBPR 3, DM or AGM will do. CBPR 4, high risk, if it is DGM will do at RM being HO. Approval by RM being only. Right? CBPR for proposals above 50 crores confirmed by individual authority at HO shall be placed to next higher authority for review. 50 crores, above 50 crores. It will be next higher authority for review, it will go. Now it comes CBR 5 no go. Once assessed by RM wing, because they will approve it, RM wing, this such proposal shall be placed before CGM or GM level committee for approval review of HO. That means no go accounts, it has become high risk. In such case, it will be reviewed at higher level, next higher level. No authority less than MC of the board can permit new or fresh exposure or enhancement for proposal rated as no go. These are restrictions. No authority other than MC of board, top apex level of the bank, I mean MC of the board. Only they can permit new or fresh exposure, those who are rated as no go. Right? Next, this is another recalled question. Applicability of ESG and climate risk parameters. Environmental, social, governance, ESG parameters. Applicability. Earlier it was not there, but now it is made applicable, introduced in CBPR model for corporate borrowers having exposure more than 50 crores. 50 crores and above. Fund-based and non-fund based. And weightage is also given, 10% weightage is given in CBPR model. So ESG is introduced in CBPR. What is the cutoff limit means? 50 crores and above. This is record. Next, we go for risk rating policy of the bank. Risk rating. Internal ratings and pre-days, probability of default. They are based on a 1 year forward looking risk horizon. As I told you, internal rating, particular low risk or moderate risk. How many moderate risk accounts are becoming NPA in 1 year? Only 1 year horizon only we will see. So these internal ratings, generally it is for 1 year horizon. That is why yearly review of risk rating also we will tell. Right? And review on annual basis. This is not here. Listed companies and high risk borrowers review quarterly. Normally review annual basis, but in case of listed companies and high risk borrowers, review is quarterly. Right? Next, current borrower rating system. Now 4 systems are there in a current borrower. CIRM, Canada internal ratings module. It is applicable for rating of borrowers above 2 crores, where CIRM hybrid model is not applicable. 2 years back, this hybrid model has come. Earlier, above 2 crores, all CIRM only. Now, up to 7.5 crores, hybrid model has come for SME and agriculture. Right? Next, above 2 crores, 7.5 crores, MSME, traders, and agriculture and allied activities. Irrespective of turnover, you have to do under CIRM hybrid model. And for accounts with exposure above 20 lakhs up to 2 crores, it is manual model. And accounts with exposures above 2 lakhs up to 20 lakhs, small value model. Up to small value model, unaudited balance sheet also we can accept and do risk rating. But manual model and above, compulsorily audited balance sheet it is required for risk rating purpose. Right? Next, for accounts with exposure up to rupees 2 lakhs and some specific Accounts up to exposure 2 lakhs and some specific exposures, they will having pool characteristics. Then portfolio model. Includes retail lending, agriculture, educational loans, individuals where financial statements are not required. All these up to 2 lakh rupees we do under portfolio model. Next, borrowers who are new to business, not at all availed any credit facility, we call them as new to borrower. Okay. New to business. And new to bank means borrower he availed credit facility from some other bank and approaching our bank for first time. Next, rating mapping also given. We will need that because it is only table. Once borrower moves out of NPA, they shall be assigned high risk 3 until next rating. So if borrower is coming out of NPA means all loan arrears are cleared. In such case, immediately they will be assigned a high risk 3 until next rating. Right? Next, CARM hybrid model, I told 2 years back it has come for borrowers exposure above 2 crores up to 7.5 crores. It is applicable for manufacturing, trading, services, allied, agriculture and allied, where balance sheet is available. That to audited balance sheet, right? Risk scoring is in the range of 0 to 1, where score of 11 is low and 0 is high risk. Borrower who has slipped to NPA will be categorized as CNRD default. Right? Audited balance sheet shall be option basis for CRM hybrid. Okay. Balance sheet with revenue of minimum 12 months shall be only be considered. Security coverage risk weight is 30% for existing borrower and 35% for new borrower. It is regarding security coverage in case of risk rating, risk weightage. Next, CARM. CARM, I told you we have developed for about 2 crores. We have developed with the help of Civil, CRISIL, and now on our own we are doing. Here only basing on turnover, different models are there. If it is a manufacturing unit and turnover is 25 crores and above, then we do under large corporate module. These are all different modules under our CARM model. If turnover is less than 25 crores, then it is a SME module. If turnover is more than 25 crores in case of traders, it is large trader. If turnover is less than 25 crores for traders, small traders, for NBFCs, NBFC, like that separate modules are there for doing risk rating of each type of borrower. Which type of borrower? Accordingly, the CARM will do risk rating. Yes. Next, confirmation. Who will confirm risk rating? Exposure up to 35 crores. Exposure up to 35 crores by DM or AGM. And beyond 35 crores up to 250 crores, DGM. Beyond 250 crores, CGM or GM. Right? Next, initiation of CARM. Who has to do initiation? Approval at head office level already given. But initiation 2 to 35 crores, it is the RM section of circle office or LCB or MCB. 2 to 35 crores. And beyond 35 crores, initiation by CRRD, RM being HO. Approval also at RM being HO only. Next, risk category wise weightages, how much they have given. For existing borrowers and new borrowers is given in this. It's only percentage. Industry risk 5%, business and management 15%. It is weightage while doing risk rating. How much weightage is given for each parameter? Industry risk, what type of industry is this? Like that. Similarly, business and management risk. Who is management? Their qualifications, experience, etc. That 15%. Financial risk, how their financials, is it good? Debt equity ratio is good, or their capital is good, like that, they will give 35% weightage. Security coverage, 30% or 35%. 30% in case of existing borrowers and 35% for new borrowers. And conduct of accounts. It is for existing borrowers only because we are having all this part sheet, basing on that we see. Whereas new borrowers, there is no account, conduct of accounts, so not applicable. Right? Next. Manual model for rating borrowers with exposure above 20 lakhs up to 2 crores. And the small value model, I told you 2 to 20 lakhs. For this, again, ratings are there up to 8 scales. CNR1, Canara rating, manual model 1 to 8. Similarly, small value model, Canara rating, SME, small value model 1 to 8 ratings. And mapping. Manual model 1 or say small value model 1 means low risk 3. Manual model 2, small value model 2 means normal risk. Manual model 3, SVM 3, it is moderate risk 1. Manual model 4 and SUM 4, it is moderate risk 2. This is mapping. Manual model 5 or small value model 5 is high risk 1. 6, it is high risk 2. 7, high risk 3. D is default. Since 8 grades are there, this mapping is also. Suppose if they get MMR1, we can say consider as a low risk 3 party, LR3, very good party, all concessions, etc. Right? Next, risk rating process and confirmation. Who will do risk rating and who will confirm? So this all only earlier I told you up to 2 crores, 2 to 35 crores, who will initiate and who will approve. So it is only authorities who will approve. So we will not concentrate much on this. We will move for other one. Mapping of CIRM. High risk triggering points. Earlier also we have seen. Now for CIRM, separate triggering points. One is negative tangible net worth. Second one is NPA with other banks. Third one, cash loss for past 3 years. Fourth is auditor's comment on going concern. If one of the above triggers, it is HR1. If 2 triggers, it is HR2. If 3 or 4 triggers, it is HR3. This is how we do high risk parameters. Right? Next, PD estimation 5 years, LGD 7 years, as already I have discussed this. Now, validity of credit risk rating. As I told you, it is annual exercise. And what is the validity? Credit risk rating of borrowers shall become overdue for updation after expiry of 15 months from the month of confirmation of rating or 18 months from the date of signing the balance sheet by auditors, based on which credit risk rating was assigned, whichever is earlier. And no credit decision after expiry. As I told you, this rating will expire after 15 months from confirmation of rating or after 18 months from the signing of balance sheet. Right? Afterwards, there is no decision regarding internal decisions, whether interest concession, etc. We will not consider if balance sheet is more than 15 months or 18 months, as the case may be. Right? Next, retail risk rating, it is basing on scoring model. 70% and above we consider as a investment grade. If a party secures 70% and above marks, then only we will finance. Right? Scope of application of external ratings, where we have to do short-term rating, where we have to do long-term rating. If up to 1 year, we do short-term ratings, A1 plus, A1, like that, it will come. And beyond 1 year, triple A, double A, single A, BBB, like that, they will give for long. Beyond 1 year, it is long-term ratings. OD OCC also, though tenability is given for 12 months, but it will be rolled over continuously. That is why it is done under long-term ratings only. Right? Facility rating, yes, recently it has come and current, very important for current exam. What is this facility rating? RBI, as per RBI guidelines, in qualifying internal ratings based rating system, they must have 2 separate. IRB, I told you, no, we are migrating to IRB. That is what, now, instead of standardized approach, we will migrate to advanced approaches. IRB. To migrate to IRB, we have to do 2 ratings. One is borrower rating. That is what you are doing, your credit risk rating of the borrower. Second one is facility rating. For each exposure, separately, we will do facility rating. So 2 ratings are required if you want to migrate for advanced approach. This is what Reserve Bank is telling. Hence, we have introduced this facility rating recently. The risk of the borrower default, that is borrower rating, it is reflected in probability of default basing on your credit risk rating exercise. Transaction specific factors, that is what facility rating. It expresses LGD, loss given default, right? And must reflect transaction specific factors such as collateral, seniority, product type, etc. And it reflects economic loss. That's what I told you. In your probability of default, we do only risk rating of the borrower. Loss given default, we do risk rating of the facility. As I told you, how much collateral it is having, security or any other securities are available. And what will be economic loss? It will be if it becomes NPA. Economic loss includes not only your actual loss in this, and for recovery also we will be spending some amount, advocate fees, etc. That also it will be included. That is what total economic loss, how much you are incurring. right? And facility rating is useful as input tool for loan approval and sanctioning. For our credit decision also, it is useful. And applicability, corporate exposures above 7.5 crores. Because retail is up to 7.5 crores. So here corporates above 7.5 crores, facility rating is applicable. This will be done at head office level only, facility rating. It will be carried annual basis, preferably along with your CIRM rating. Along with CIRM rating, it will be carried out annually. And a competent authority who is empowered to confirm CIR rating, they will confirm this rating also. Earlier I told you, up to 35 crores, it will be done by DGM up to DGM level, and beyond that higher level. So similarly, same authorities, whoever that CIRM rating confirming authorities, here also facility rating also, up to same cutoff points, same authority will confirm. Score range and assignment also same, 11 grades, just like your CIRM. Because it is done along with CIRM. LGD is assumed to be constant at 90% for the probability by default LGD default approach. So PD is 90, it will be 100. This is what percentage. Of course, it will be calculated head office. We need not worry. And next, it is measurement and standardized approach, Basel II framework. All risk weights it is given here. As risk weights are covered, I will also skip this risk weights and go for further. Because already our Jagannath sir also covered all these risk weights, including regulatory retail also, 3 parameters that also covered. This housing loans risk weight also be covered. NPS risk weight, venture capital, etc. It has come. Basel recognized collaterals, this also Jagannath sir has covered. Collateral management, here also only your current assets and fixed assets valuation, it is already covered. Current assets, fixed assets, once in 3 years, fixed assets, current assets yearly, all your cutoff points, I will cover. Stock audits, low risk and normal risk, 5 crores and above once in a year. Moderate and high risk, 1 crore and above once in a year. Substandard and doubtful, 1 crore and above once in 2 years. But doubtful assets, 5 crores and above once in a year. So these are all periodicity of your stock audits. And this another one, ASM, agencies for specialized monitoring. For this cutoff point is 250 crores and above. It introduced about 5-6 years ago. They have introduced these ASMs. They will do ASMs. That means some chartered accountants, they will come and all your cash flows, etc. they will work out. Quarterly, they will submit report. And for them, remuneration also we will pay. What is the remuneration amount here? Up to 5 lakh plus GST for limit up to 250 to 500 crores. If exposure is more than 500 crores means it is 8 lakhs plus GST. That is what remuneration we pay, but it is payment is quarterly for these ASMs. Okay, fixed assets valuation once in 3 years. In case of housing loans, etc., 50 lakhs and above every 5 years, once in 5 years. 5 crores and above, 2 valuations. It is several times recalled question. 5 crores and above. Next, if it is purchased within 1 year, acquisition value, beyond 1 year, 80%, 85% of market value. If sale deed or gift deed means there will not be any amount mentioned in that. In that case, from sub-register office, we can take guideline value. These are all for valuation purpose. Beyond 12 months, normal. Sugar stocks, we need not worry. Agricultural properties, if there is superstructure like a shed, dairy shed, poultry shed, etc., once in 3 years. If no superstructure, only open lands, once in 5 years. Here, AUOs and AUO promoting managers for limits of 30 lakh, not here value of your property. Limit up to 30 lakhs. AUOs and AUO promoters can do, and other managers, they can do up to limit of 20 lakhs. Here also 5 crores and above, 2 empaneled valuers, they have to do. Minimum gap between, normally minimum gap between 2 valuations should be 3 years. If it is, evaluation is done in lesser than 3 years. Earlier it was lesser than 36 months. Now it is reduced to 33 months. If valuation is done in lesser than 33 months, then you have to consider 85% of the present value only. as per latest one, right? Now we move for credit monitoring tools, which we have planned in today's session also, that we will 24-year knowledge bank. Yeah, here it is there. Credit monitoring tools. Yes, sir. Of course, in half an hour normally, I think I will complete it. Credit monitoring tools. In olden days, this credit monitoring tools also it was included under credit policy, CRM policy, credit monitoring, all in one policy only. In olden days, we used to get, but now it is separately given. So the intention is everything, whatever it is, to minimize the losses. To minimize the risk means to minimize the losses and to get profits ultimately. So here also, if you are sanctioning loans means it should not become NPA. For that, you have to do good monitoring. So for doing good monitoring, what all we are supposed to do, it is prescribed in our credit monitoring data. Here, review of credit sanctions made by each authority will be reviewed by next authority. This is common guideline for that. And mostly for exam purpose, they are asking here it is 5 lakhs and 6 lakh cutoff, and all sanctions up to 5 lakhs fund based and non-fund based, and is up to 6 lakhs for SHGs. They review on consolidated basis by RO. So they are asking in exam, what is the cutoff point for sending credit reports to next higher authorities for review? So beyond this limit, we have to send credit reports, your sanction letter and appraisal to next higher authorities for review. So above 5 lakhs in case of other loans and above 6 lakhs in case of SHG, we have to send individually to next higher authorities for review purpose, right? Okay. Everything next to higher authority, all loans sanctioned by each authority will be reviewed by next to higher authority. Only periodicity it is given. That's why we are not going much on this periodicity. Anyway, these periods you can go through. I will in PowerPoints it will be circulated. And pre-release audit. What is this pre-release audit? Why it has come? Actually, in 2014 it is introduced, 10 years ago. Why it is introduced? I will tell you. In some branches, maybe due to pressure or maybe due to their target purpose, without the completion of documentation, loans are disbursed. And subsequently, party is not coming forward for completion of documentation or submission of additional required papers, etc. And problems are arising. To overcome this, bank has started this pre-release audit. What the bank is telling is, you take documentation, and within 48 hours from documentation, somebody from other branches or controlling offices, scale 4 and above, they will come and do this pre-release audit and check whether documentation is perfect or not. Any deficiencies, they will bring it to the knowledge of next authorities. This is the intention of pre-release audit. Now, what is cutoff point here? 3 crores and above. That means loans given 3 crores and above, they are subjected to pre-release audit within 48 hours of documentation, right? Retail lending loans 5 crores and above backed by mortgage, they are subjected to pre-release audit. In case of ad hoc, if it is crossing total, regular plus ad hoc, if it crosses 3 crores, then it is applicability. And what is this enforceability certificate? Panel advocate who has, other than who has given LSR, this panel advocate will give enforceability certificate. That means basing on LSR and other properties, whether these properties can be enforced in case of need, whether we can proceed under surface, etc., etc. That certificate they will give. It is called as enforceability certificate. Right? Next, for enhanced limits, etc., etc., such report from CERSAI and ROC, everything they will verify whether it is entered, CERSAI entered or not, and ROC registration is done or not. That also it will be done. So remuneration to panel advocate for this conducting enforceability certificate, it is minimum 1,000 rupees and maximum 10,000 plus GST. And we have to bear debit to general charges. And pre-release audit to be conducted by scale 4 and above. Documentation, collection of applicable charges, CRSI, etc. They will verify. And pre-release audit, they have to complete within 48 hours from obtention of documentation. CRM section CO is nodal point. normally they will alert who has to go and do this pre-release audit, CRM section CO. And no authority is empowered to permit waiver of pre-release audit, right? This is about one monitoring tool. Next is credit audit. Pre-release audit regarding documentation. Credit audits regarding compliance of terms and conditions and how account is progress after disbursement, whether all disbursements are done in promptly as per our norms or not, and appraisal, etc., any problem like that, everything they will check in credit audit. Since the account also they will verify, this audit is done after 3 months from disbursement, but before 6 months. This is period. Credit audit is done after 3 months from disbursement, before 6 months. Right? Now, cutoff limit same 3 crores rupees. Within 3 to 6 months from the date of first disbursement, they have to do. CO to alert less than 3 crores also randomly up to 5% maximum number of accounts. Next, if additional facilities are permitted frequently, ad hoc or continuously permitting, in such case, maximum 2 credit audits in a year is permitted. And with a gap of 6 months between 2 audits. Right? Limits below 5 crores, credit audit by internal staff or external auditors. Even our internal staff also, they can conduct a credit audit. And 5 crores and above only by external auditors. And what is the fees for external auditors? 6,000 rupees. Closure of credit audit remarks normally within 3 months. Suppose if joint documentation or your pari passu charge, that some mortgage, etc. is problem. In such case, maximum 6 months time is given. So normally 3 months. If any second charge, documentation, joint documentation, etc., maximum 6 months time. So credit auditor, what they will visit? They will visit the unit, verify the books, stocks at random for moderate risk and high risk accounts. So this is about credit audit. Next, stock audit. As I told you, it is a yearly exercise and the cutoff is your low risk and normal risk. It is once in a year, 5 crores and above cutoff. And moderate risk, high risk, 1 crore and above cutoff, once in a year only. Unrated, 1 crore and above, they have to do. Suppose NPA, again, it is once in 2 years, standard and substandard, but 1 crore and above. Doubtful, 5 crores and above yearly. This is about periodicity of your stock audit, right? And applicability that we have seen. In case of takeover, stock audit is a pre-release condition, takeover, but stock audit waiver is also permitted. When it is permitted, stock audit, in case of takeover, if other bank is providing stock audit reports less than 6 months or up to 10 crore rupees, waiver is permitted. If other bank stock audit is given less than 6 months, duly verifying 3 stock reports of previous 3 months this firm. And up to 3 crores, we can waive same, again provided same condition. Previous 3 months stock audit reports are to be verified. And stock audit, if it is a more than 6 months old with other bank, up to 3 crores we can waive. So here, while takeover, stock audit waiver is permitted up to 10 crores if previous banks are having stock audit report of less than 6 months old. If it is more than 6 months old, stock audit waiver is permitted up to 3 crores only. In both cases, 3 months stock statements we have to get and verify. This is for waiver of stock audit, right? Next, downgradation of risk rating by 2 notches, stock audit within 3 months. And next one, if any account slip to NPA, stock audit within 6 months of slipping to NPA, because we have to allow cooling period of 3 months for upgradation. If in 3 months, if it is not upgraded, then maximum within 6 months from date of NPA, you have to complete this stock audit exercise. If it is a consortium or JLA, we will go with other banks. High value items, stock auditor, these chartered accountants actually what they will do, high value items, they have to check 100%, and medium value items, 25 to 50%, they have to check. CO will allocate stock audit, whatever it is there, maximum 6 audits will be allocated to a stock auditor in a year. Actually, from June onwards, CEO will plan. Entire exercise is to be completed by December. This is the time norms for stock audit. Credit review and monitoring format, CRMF. Earlier, CMF was there, midterm review was there, MTR we call. Both clubbed subsequently, and now CMF and CMF come MTR, again clubbed. Now single format has come, CRMF, credit review and monitoring format. Right? Here, again cutoff point 3 crores and above. Earlier, different cutoff points were there. Now all are made commonly 3 crores and above, low risk or normal risk or moderate risk. Right? Next, high risk accounts, fund based and non-fund based above 1 crore. This is cutoff point for CRMF format. And now it is periodicity is quarterly. Earlier olden days it was once in 2 months. Now it is quarterly. 30th June, 30th September, 31st December, and 31st March. It is to be submitted within 10 days from due date. This is the condition. Next, if sanction renewal ad hoc takes place in any of the above mentioned months, that means June, September, December, or March. If sanction or renewal or ad hoc takes place, then need not prepare for that month the CMRS. For that quarter, the CMRF is not required. And term loans also annual review is there. Suppose in a particular quarter, term loans annual review is done, means for that quarter, CRMF is not required. Right? Next, this CRMF, suppose they have to enter in package, SAS based portal package they have to enter. And after entering all details, PDF file is to be downloaded. It has to upload. The generated PDF file will be uploaded in LCM module, large corporate monitoring module. They have to upload. Entire process, it is to be completed within 10 days from the end of quarter. This is about CRMF formats. Main cutoff 3 crores and above, high risk, it is 1 crore and above. Quarterly submission, second one in this. Right? Next, ASM, agencies for specialized monitoring. Earlier I told you 250 crores and above cutoff point for this. It is introduced about 2-3 years ago only, not older one. And standard restructured, NPA restructured accounts, project under implementation, all accounts are eligible. And again, this monitoring they will do quarterly. That ASN means that agencies, they will do quarterly. And fees for them is 5 lakh rupees up to 500 crores exposure, and 8 lakh rupees for above 500. Is already we have discussed this, payable quarterly, this fees. And camping HO, they will appoint ASM from IBA list who is having more than 10 years experience. This people, right? Yes. Annual review of term loans. Yes, another 10-15 minutes, please. Annual review of term loans. Annual review. Standalone term loan sanctioned by CO head CSC and above eligibility. This one, standard restructured and NP accounts not marked for recovery. If borrower is enjoying working capital and term loans, this term loan will be review will be done at the time of renewal of working capital limits. And retail loans up to 5 crores sanctioned by CO head CSC, they are exempted. Right? When annual review of term loans takes place, CRMF is not applicable. Already we have covered this point. And one-time review by CAMWing after 6 months from sanction. Okay, HR accounts, etc. Therefore, yearly is not required. In case of projects under implementation, review based on LI and PAPR. That also will come, I will discuss. Investment trust. Earlier we have discussed about INVITs. Only thing is here, monitoring point is that half yearly, whoever availed loan from us, this investment trust, half yearly they have to submit a CS certificate, Chartered Accountant certificate. Compliance of their SEBI guidelines and RBI guidelines. Only this much, right? CERSAI. To proceed under SERPACI, registration and CERSAI is a must. Charge created on mortgage, hypothecation, on movable assets, intangibles, and agreement during construction. Suppose flat is under construction. In such case also we can do registration with CERSAI basing on agreement, right? Next, on the same day of loan opening in CERSAI, you have to complete this also. Such a report in CERSA mandatory before sanction of any loan against EMT. And fee for addition, it's already figures only. I will need not go through that much. Okay. Quick mortality only in this. What is quick mortality account here? Liability, cut-off liability, now it is enhanced to 15 lakhs. Olden days it was 5 lakhs only. So loan with aggregate liability of 15 lakhs and above, if it is becoming NPA within 12 months from the date of commencement of repayment, either interest or installment. Olden days it is from the date of disbursement it is there. Now it is from commencement of repayment, 12 months in respect of loans limit sanction to the party for first time. That means he is a new borrower, availed 15 lakh rupees and became NPA within 12 months from commencement of installment. Then we classify it as a quick mortality account. Only definition in this class. Right? Credit monitoring officers in branches. Here cutoff point is 50 lakhs and above. To monitor accounts with total exposure of 50 lakhs and above. And branch level credit monitoring committee will be there. Branch head, SM of credits and CMO. They have to meet weekly. CMOs, they should utilize large credit monitoring module. This LCM also I will discuss what all we have to upload in LCM module. In next it is there, I will discuss. Right? Any specific observations of 10 crores and above, they have to copy send to Camming HO. And CMOs, they have to do risk rating under manual model, more than 20 lakhs up to 2 crores. They have to do risk rating. Right? Special mention accounts and return on default borrowers. SMA, it is already covered, SMA 0, etc., etc. We need not worry about this. Every Friday, CRILC report, I told you 5 crores and above. If any overdues are there in any account, if it is falling to SMA, then we have to report to CRILC weekly. And any recoveries in that account, if it is coming out of SMA, again weekly, it is to be reported. One is slipping and second one is recovery. Both we have to do. This is again old classification only. We need not worry. Monitoring branch head. Okay. Who has to monitor? RO head 25 lakhs and above, CO head 100 lakhs and above, and HO 5 crores and above, Cam Wing above 5 crores. Right? SMA call center. Book liability up to 1 crore through Quest Corp Limited. This recently it has come name. That's why I have put in this back office support. Pan India. Follow-up of recently slipped NPA accounts. Who has to follow? Again, report you have to generate up to 25 lakhs CRM section RO, 25 lakhs to 1 crore CRM section CO, 1 crore to 25 crores new NPA section monitoring cell Camming HO. They will monitor, and 25 crores and above monitoring section Camming at HO. This who will monitor? This is what I told you, large corporate package. I will discuss at the time. I told you, no. What is this large corporate package? Applicable for fund-based and non-fund-based 1 crore and above. All details of borrowers and periodical statements, whatever we are taking from them, starting from your stock statement onwards, we have to upload in PDF file in this module, right? And pillar-wise data we have to upload. What are all we have to upload? MSOD. MSOD is applicable for 10 lakhs and above working capital limits. Monthly they will submit. MSOD along with stock statement they will submit. So MSOD, stock statement, book debt statement, because party will be submitting monthly, we have to upload in this. Next one, QoS and HOS. QoS is quarterly operating system. Once in a quarter, within 6 weeks after completion of quarter, they will submit. Similarly, HOS, it is half yearly. Within 8 weeks from the end of half year, they will submit. It is applicable for fund-based and non-fund-based 5 crores and above working capital limits. So this is to be uploaded in this package. Next one, LCM package. Similarly, audited balance sheet, yearly it will be uploaded. PIPR, project implementation progress report. Generally 50 lakhs and above term loans, we will accept this. 50 lakhs. And it will be uploaded. The LIE, lenders independent engineer, if we are appointing, then we have to take a report. This report will be uploaded. Generally PIPR, it will be submitted quarterly, right? Stock audits, uploading yearly, because stock audit exercise is yearly exercise, we will upload at that time. Credit audit 3 crores and above, within 3 to 6 months from the date of disbursement, credit audit will be done, that will be uploaded. Pre-release audit within 48 hours after documentation, this will be submitted. This also we have to upload in large credit monitoring module. Similarly, unit visit, stock inspection, consortium and JLA meetings monthly. Within 3 days, they will submit. That also will. Similarly, credit monitoring and review CRMA format quarterly, it will be uploaded. GST returns 5 crores and above, it is applicable. Wherever GST is there, that also they will submit and it will be uploaded. ASM 250 crores and above cutoff, they will submit report quarterly. That also we will upload. So these are all we have to upload in this large credit monitoring package. Next, higher authorities for review purpose. Credit monitoring cells at branches, ROs and circles. Separately cells also we have to, and it is mandatory for branches with exposure working capital and term loan 50 lakhs and above. At ROCO, to look after slippage management. Review of SMA accounts with above 5 lakhs. With branches or ROs or COs. SMA, B, C, D. Okay. Stock statement and MSOD, as I told you, 902 stock statement, monthly they will submit. MSOD, industrial borrowers with working capital limits, 10 lakhs and above, along with stock statement, they will submit. Normally, debtors up to 90 days we will finance. Basing on type of business, more than 90 days also, it will be considered. So it will be, and why it is given here is whether to mention in stock statement, whether we have to consider for drawing power calculation or not, this point. Up to 90 days normally we consider, but up to 180 days also generally in case separate cases we will permit. Exposure 5 crores and above, GST returns. If they submit, yes, along with stock statement. QoS and HOS I have discussed this. BG report 5 lakhs and above, half yearly they have to submit. And PIPR, I told you, project implementation progress report, it is applicable for term loans 50 lakhs and above. And to be obtained quarterly basis during implementation, during construction of this project. If it is a term loan for industry purpose, during construction period, they will submit this PIPR. Quarterly, they have to submit. Duly signed by chartered accountant or chartered engineer. Obtain lenders independent engineer certificate if they are appointed. And LI is to ensure utilization of funds and timely completion of the project. LI services for non-infra projects with project cost more than 50 crores. Normally for all infra, we will be appointing LIE. For non-infra, above 50 crores, we will apply, we will appoint LIEs. Lenders, engineers, they are experts in, it will be a firm, big firm, experts in this construction area. They will periodically, they will inspect and submit report to us, LIEs. LIE will evaluate project, funds infusion by party, how much is infusing, monitoring through PIPR, project implementation, project report or CA certificate. Funds infusion is more important because equity risk we call. If party is not infusing required equity, simply if we are continuously disbursing loans, then debt equity ratio will be adverse. So equity risk will arise. That is why funds infusion, it is to be monitored. Generally, LIEs, they will monitor. And monitoring of high risk accounts, 10 crores and above. Exposures of 10 crores and above, all LCB accounts, including MSME sector, excluding agriculture, it is undertaken by CAMBing HO, 10 crores and above. NCLT accounts monitored by SAMBing at head office. Who is monitoring NCLT account means SAMBing at HO. Agricultural credit is monitored by priority credit wing at HO. Generally, it is common. Borrower accounts with exposure 200 crores shall be subjected to review and monitoring by CAMBing. Right? Consortium and NBA accounts 50 crores and above, half yearly review by CAMBing. Notes placed to CRMC HO, MDCEO by CAMBing. Who will monitor so and so exposures? This is all guidelines plus. Right? 25 crores and above SMA accounts by SAMBing. Monitoring of cross default and other financial covenants. What is here cross default means? If there is any deterioration more than 10% at expected, suppose debt equity ratio at the time of sanction you have accepted. Similarly, current ratio at the time of you have accepted some ratio. After 6 months at the time of review, there is a variation of more than 10%. Then we call it as a breach. So we have to monitor such breaches. It is applicable for large corporate exposures 50 crores and above, listed corporates 50 crores and above, and listed MSME 1 crore and above. This applicable, monitoring of cross default. What is this cross default? Default with one lender that may trigger default with another lender. If one banker it is becoming NPA and the other bank also it may become NPA shortly because party is facing some problem, it will indicate. This is what cross default we call, right? Default in debt at parental level may trigger default in group accounts also. Default with any bank for more than 30 days, we call it as cross default. If it is not settled within 30 days, then only we call it as cross default. If it is rectified in 30 days, yes, it is not a cross default. Monitoring quarterly through CRILC reports or CAC reports. Profit and loss covenants quarterly we will monitor, and balance sheet covenants yearly we will monitor. This is about monitoring of cross default and other financial covenants. Incomplete or pending documentation. Normally, olden days it was there. Now there is no question of pending documentation because pre-release audit has come into existence. But it is applicable for 5 crores and above quarterly review. We have to inform the next higher authorities any pending is there. Generally, it will not arise because of your pre-release audit. Next, LIE. It is already old one only, 20 characters one, alphanumeric code, alphanumeric. Cutoff point for obtaining this LIE, 5 crores by 30th April 2025. 5 crores, 10 crores people, they have to pay this. You know that after 24 months, within 36 months. Okay. Yes, friends. This is about money. Some things I have not discussed. You may this point any. Yes, sir. Sir, Anand, sir.
Yes, sir.
Yes, sir. Shall we wind up the session?
Yes,
It is
sir.
Yes. Thank you, friends. Thank you very much for almost afternoon. It is what I can say. It is a weight, dry subject and weight, of course. Thank you, sir. Thank you.
Thank you very much, sir, for
Yeah.
sharing your valuable time.
Yes, sir.
Sir, this PPT also you have shared, sir?
Yeah. Everything, sir. Earlier RBI notifications plus related one.
Okay. RBI PPT, I saw it.
Yes, sir. This monitoring tools, I think even now one day prior or now also again I will send now itself, sir.
Yes, sir.
Yeah, immediately I will send.
Okay, sir.
Yes, sir. Yes, sir. Thank you, sir. Thank you.
Thank
so
you.
I will stop sharing everything. Thank you. Yeah.
Friends, materials will be shared today evening by evening, and video recording I have to download. Once it is downloaded, I will share it through our team. Retail lending classes will be uploaded today evening. All materials will be uploaded. If you are in group 1 to 7, there are 7 groups. If you are in that group, it will be available. And we are also sharing in our WhatsApp channel. If any one of you is not in the group, kindly message me in my number. I will put you in any one of the groups. Mock test Mr. Timareddy sir is conducting. Maybe probably there will be a test tomorrow. He will announce. Tomorrow there is a class on MSME. Tomorrow and day after tomorrow. Thank you. Thank you all. Shall we wind up this session? Sir, Mr. Jairam, please put a message to me. I will share the link to you. Tomorrow 7:15, sir, class. Madam Divya will be handling 7:15 to 9:15. It will be handled by DM from Teni, MSME Sulabh. So tomorrow and day after tomorrow, she will be handling on MSME. Sunil Kumar, just now I told you, just drop a message to me. I will put you in any one of the groups. Thank you. We'll wind up the session. Good night.